got a broad story where the economic fundamentals look good. Right, the growth story is pretty good. Inflation is coming down.
As far as what the Fed signaled, I think it was a very balanced sort of a message.
We're seeing slowing in growth, but we're not really seeing such severe slowing that monetary policymakers seem like they really need to act urgently.
I don't think there's a lot of concerns necessarily about the U.S. economy going into recession.
The Fed's telling you they're going to cut rates even if the labor market stays tight. So if it weakens, they're just going to cut a lot more. There is a support network that's happening there.
This is Bloomberg Surveillance with Jonathan Berro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. Upgrading U.S. stock forecasts into thinning air. Good morning. This is Bloomberg Surveillance. Anne-Marie is back from eating gelati and antipasta in southern Italy. John is doing his tour of duty somewhere beautiful and warm. He is off for the week. We are the lucky ones, however, because Danny Berger has agreed to join us throughout the week. Thank you so much for being with us. It is a week of so much Fed speak. It was the quiet period. Now it's the Fed's loud, very, very, very loud period. We have some key data. We also have this really big tension that's been culminating this week and over the weekend with a series of S&P forecasts to the outlook for year end. Danny, at a time when it's really being driven by a fewer group of stocks.
Yes. It was a record divergence last week between the market cap weighted and the equal cap weighted. And you look at Julie Emanuel, who basically says this upgrade is because of AI, is the early innings. Lisa, I think it's interesting to turn it on its head, not to say, should we be really worried this is a bubble, but to say, should we be worried that the rest of this market isn't playing ball?
This is something that Lori Calvasina picked up on from RBC Capital, saying that it's making her really uneasy. She can understand the logic underpinning why NVIDIA and Microsoft can keep leading things going along. But this is a record divergence with the small cap stocks. And you have to wonder at what point people don't participate. It just raises the question of the vulnerabilities. And that's sort of the angst that you feel, Danny, underpinning some of this.
Yes, it is, because the margin of error is really narrow if it's only a few stocks leading it. But what is going on with the rest of this market? I mean, the economy is fine. It's growing. Earnings are okay. The Fed maybe is going to cut this year. Is this a David Einhorn moment of the market is broken and there are too many price-insensitive buyers?
Well, it just raises the question of what could potentially go wrong. Anne-Marie, there is this issue, not you, but when it comes to the political risk at a time where so many people say it's impossible to be able to really price that out. And yet last week, it really was in cold relief with what happened in France. How much was that really hanging over the G7 in a way that a lot of people didn't expect?
Domestic politics was almost the theme of this G7. They were able to get some deliverables over the finish line, but all of this, there are issues at home. That is what was striking for so many of these leaders, because they stood around the table, and I think it was Politico that had the headline, "It's Meloni and 6 lame ducks." And that is exactly what it felt like, because what is going on in France? And Peter Cheer over the weekend had this note saying that Europe is making markets interesting again. And he didn't have a European debt crisis on his bingo card. He says, okay, that's long down the road. But he's saying the fact of the matter is you can have the far left and the far right potentially win big. And then what does that mean for the center when it comes to France?
And you can see the spread widening out between French and German bonds to the wides that we haven't seen since 2011 of the debt crisis. But I'm just wondering, when you forward it into the U.S., which is the stalwart market that everyone seems to be coalescing around, Anne-Marie, what are some of the vulnerabilities over the next 2 weeks? Forget heading into November as we head toward this key election, as we talk about fundraising and a whole host of domestic issues that are coming to the fore.
It's full on campaign mode, whether or not you're on which side of the Atlantic. And Biden went immediately from an international gathering to this campaign event, star-studded event. He raised some $30 million, according to the campaign. But the issue of his age, that was on display at the G7 as well. When you look at some of our reporting, what some officials and other delegates were saying and concerned potentially about his age. And that was on display as well in Los Angeles. And this is going to be something he needs to overcome at that debate in the next 2 weeks.
Yeah, unclear exactly how he's going to do that. We'll be talking about that and so much more. Let's just get a sense of the state of play, as we did have the 29th record high last week on the S&P 500. We're starting on a softer note, albeit this is not a softer note. This is basically flat. You've got S&P futures just a touch away from 5,500. You have, of course, Evercore ISA talking about 6,000 by year end, which is about 10% upside from where we are. The euro gaining just a touch versus the dollar after a really punishing session last week. 107.13. 10-year yields just marginally upward, but still so much lower than where they began last week before we got a slew of data that spoke a lot louder than the Federal Reserve. And crude just basically hovering around that $78.38 mark. I want to take a look at the week ahead, which really comes down to three big data points. You've got retail sales on Tuesday, jobless claims on Wednesday, and the S&P, the jobless claims on Thursday, and the S&P global PMIs on Friday to give a sense of just how much we could get some sort of upset there. It is not the quiet week. It is such a loud week when it comes to Fed speak. Who is not speaking? It's Williams, it's Kashkari, it's Harker, it's Barkin, it's Daly, it's every single one of them who are going to be coming out and giving their sense of just how bifurcated this FOMC really is. At this point, we're looking at basically herding cats on the FOMC, which is what you could feel under Fed Chair Jay Powell's words. Coming up, Andrew Sheets of Morgan Stanley with two stocks coming off 2 weeks of gains. Terry Haines of Pangaea Policy as Biden and Trump ramp up their campaigns. And Nela Richardson of ADP looking ahead to a slew of Fed speak this week. We begin with our top story, stocks coming off 2 weeks of gains as investors eye a slew of Fed speak on deck. Andrew Sheets of Morgan Stanley writing this: a clear path of disinflation, growth, and policy over the next few months sets up a constructive outlook across markets, but beyond year-end, many uncertainties drive a wider than normal bull versus bear skew, reflecting a greater range of potential outcomes over the next 12 months. Andrew joining us now. And Andrew, we've been talking about how looking beyond the end of this year, frankly, looking beyond the next 2 weeks is a bit like staring into the sun or beating your head with something over and over again. Andrew, what do you make of the moment we're in where you have record highs, but with a smaller and smaller cohort of companies that are really keeping it all going?
Yeah, thanks. It's good morning. It's great to be here with you. Look, I think you framed it perfectly. This is a pretty unusual, setup. And I think it's interesting to kind of claim that this is a very macro-driven market. There are obviously a lot of really important macro stories, but I think the phenomenon you just described is incredibly micro. I mean, it's really about a couple of stocks or a small number of stocks that are having an outside effect on the markets. And we see that within credit markets as well, where you see very low levels of correlation between individual credits, similar to how you see low levels of correlation within the equity market. And so I think it speaks to, first, a very idiosyncratic market. I think second, I think it's important for investors to appreciate that this is really important for how vol is so low in this environment, why the VIX is so low. If you think about a lot of different kind of stocks running in different directions, they can individually be very volatile, but if they're moving in opposite directions, they help to stabilize the overall index. So I think overall, for the moment, that lack of correlation is a helpful factor in kind of helping to keep overall markets stable. But I think it does suggest an environment of major winners and losers. And if something were to cause those correlations to rise, then you could very quickly have a lot more vol in the market.
I guess when you talk about low volatility, it depends where you look. If you take a look at the VIX, sure. If you take a look at even the mega caps that are driving this rally, they're swinging around, albeit only in one direction, up by some 10% on a regular basis. This isn't exactly a stagnant market or some sort of steady climb upward. What concerns you? What are the risks? Is it just basically the risks to the outlook of NVIDIA and Microsoft? And it doesn't really matter what the macro backdrop is. It doesn't really matter about the other 493 stocks.
Well, so I think there are kind of a couple of things to focus on. First, that's exactly the right way to think about it. The average volatility of a stock, say within the S&P 500, is not particularly low at the moment. It is higher. But because these stocks are kind of moving in opposite directions or moving independently, they help, dampen each other out. If you think about people on the deck of a boat, if everybody's running to one side or the other at the same time, with high correlation, the boat rocks a lot. If everybody's running in opposite directions, the boat's more stable. So certainly I think that means that the earnings outlooks for these very large companies has broader implications across multiple asset classes, credit, equities, et cetera. I think the other concerning factor, the other important factor is just this kind of very odd dynamic we had last week with inflation in the Fed, right? You had a very good inflation number, kind of 0.0 month over month on the headline inflation. And then the Fed comes out later that day and raises its estimates for core inflation in the summary of economic projections. And I think that confused the market, quite frankly. And the Fed was clear in the press conference that those summary of economic projection numbers didn't fully reflect the good CPI data that they just had. But I think that's left the market more concerned that maybe the Fed is more backward looking and not interpreting, not fully appreciating some of the recent slowing of some of the data. And so I think that means certainly for, say, credit markets, good is good. I think the market this week wants better data. It wants to be assured that the economy really is strong. And I think weak data will drive more fears that the Fed is kind of looking in the rearview mirror and too backward looking based on kind of the summary of economic projections last week.
Well, Andrew, the first bit of Fed speak we got post-meeting wasn't exactly encouraging in that they would have changed their dots today. We heard from Kashkari, which maybe this won't come as a surprise, saying that he thinks one cut is reasonable at the end of the year. Mester spoke to Bloomberg saying that the dots are close to my prediction. That doesn't exactly argue that they would have put 2 cuts in had they had the data in hand. So what do you need to hear from Fed speakers this week to calm you, to make things less confusing?
So, I think it's less actually what the Fed speakers themselves say. I think it actually will come down to the data. I think, we have retail sales, we have industrial production, both on Tuesday. Morgan Stanley is expecting those numbers to improve, to bounce back. I think if the market sees healthy data, then it will become a little bit more relaxed. It will say, okay, that's fine. The economy is still humming along. Inflation's coming down. We care a little bit less, exactly when the Fed makes its first cut or exactly the pace. But I do think kind of the way that the last week played out, I just think it makes the market more sensitive to weaker data prints in a way that's a little bit different, right? We've had some times this year where, good data or weak data has been interpreted positively. I think there's a risk that that's no longer the case, that the market really is rooting for better data, and weaker data will be more challenging.
Andrew, what's changed? Because that is a big change, right? That the bad news is good news, bad news now being bad news. Why is that the case this time?
Well, I do think, some of the setup from the Fed could have changed that some. I think the fact that you've seen, some of the economic data has been a little bit softer. The economic surprise indices are quite weak. I think the fact that you've started to see kind of the unemployment rate tick up a little bit. Now, we think immigration is a big reason for that. And so the unemployment rate is ticking up for maybe better reasons because the labor force is growing. But I think it's kind of a combination of those factors. And again, I think in kind of small doses, that correlation can be more uncertain. But I think what the market is probably most worried about, just because this over multiple cycles has been the major issue, is a scenario where the data weakens, the Fed is slow to react. That's happened over multiple economic cycles, and that is often the worst outcome for markets. So again, we at Morgan Stanley are expecting the data this week to be mostly better. So we think that could help. But I think it's important to watch, and investors should also be watching that correlation closely because, for any potential shifts.
Andrew Sheets of Morgan Stanley, thank you so much. And Danny, I'm glad that you mentioned the Fed speak that we heard last week, because frankly, it was all over the place. It wasn't exactly one commentary that came through. It was basically some people saying, I want to be hawkish. Other people saying, I would have cut rates, like Goolsbee, for example. Right.
I mean, but they do continue to have this refrain. We can be patient. We need to wait for 2%, that sort of thing. But didn't we make this mistake before, to Andrew Sheets' point of we can just pay attention to the data and not pay attention to the Fed speak? Isn't that the mistake we made at the start of this year when we said, they're going to cut some 6 times, and then, oh my gosh, no, they're not. We have to pay attention to that. Are we doing it again, but albeit to a lesser degree this time?
Kashkari over the weekend was asked specifically about that Bank of America report that basically says the Fed will cut rates once this year. I think that's a reasonable prediction, and it looks like it's going to be in December.
And that's what a lot of people are coalescing around. We'll be following that throughout the morning. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Hakis. Yahira.
Hi, Lisa. Oil edging higher after mixed economic data out of China. This coming as the Biden administration is reportedly ready to reopen the U.S. stockpile if prices jump in the summer months ahead. Amos Hochstein, President Biden's closest advisor on energy, told the Financial Times the administration will do everything they can to make sure the market is supplied well enough to ensure as low prices as possible for American consumers, which includes releasing more oil from the Strategic Petroleum Reserves. The U.S. has mopped up almost 1/3 of all the global investment flows since COVID. Analysis by the International Monetary Fund showing that the U.S.'s share of financial flows has climbed, with higher interest rates a major draw for overseas investors. The U.S. has also pulled in a fresh wave of foreign direct investment. But there may be challenges ahead from Fed rate policy and the presidential election, which could affect the fiscal deficit. And Pixar's Inside Out 2 is Hollywood's best debut since Barbie. The movie grossed $155 million at the box office in the U.S. and Canada, besting Dune Part 2 as the movie with the biggest opening weekend of the year. The film also notching a record. Inside Out 2's nearly $300 million haul globally is the biggest opening weekend in history for an animated film. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. It's nostalgia, it seems like. That's what sells, right? It's like the Dune 2, Inside Out 2. You want to see it. You haven't been to a theater before, since
I have
COVID.
not been to a theater.
All right, we'll have to change that. Up next, campaign season at Kicking Into Gear.
The Supreme Court has never been as out of kilter as it is today.
4 years ago, our border was secure. Inflation was nowhere to be seen. We didn't have inflation. The world was at peace, and America was stronger and more respected than ever before.
That's coming up next. This is Bloomberg. We're still debating Inside Out 2, and we are going to take Anne-Marie straight from southern Italy into a movie theater in New York City for her day off. This is Bloomberg Surveillance on a day where we're not seeing much market action after a week where really we saw 4 straight record highs, 29th of this year on the S&P. Today we're down about 0.1%. Not a lot of drama as we take a look at the concentration here. Yields just up a touch, a basis point. This again, not a lot of drama. Euro gaining just a touch, but really flat, 107.05. Well, I'm really selling it. Let's get straight to it. Under surveillance this morning, campaign season kicking into gear.
The next president is likely to have 2 new Supreme Court nominees. 2 more. He's already appointed 2 that have been very negative in terms of the rights of individuals. The Supreme Court has never been as out of kilter as it is today.
4 years ago, our border was secure. Inflation was nowhere to be seen. We didn't have inflation. The world was at peace, and America was stronger and more respected than ever before.
Here's the latest. Donald Trump and President Biden ramping up their campaign efforts over the weekend ahead of next week's first presidential debate. That coming as a Pew Research poll shows that 1 in 4 voters don't like either candidate, so-called double haters. That's twice as high as it was in 2020. Joining us now is Terry Haines of Pangaea Policy, who's on top of everything from Inside Out 2 to what we should be watching ahead of that key debate. Terry, where is your center of focus on a week where we have a lot of rhetoric and, frankly, a lot of concerns about voter enthusiasm given those double haters?
Oh, other than Inside Out 2, I think I think what'll happen is, you'll get a ramp up to the June 27th debate over the next couple of weeks because there won't be much going on in politics, and everybody will wrap themselves into a tizzy about this stuff. But it actually is consequential in a lot of ways because, as you were pointing out before, and it's one of my analysis points as well, Biden's got to show pretty much every day between now and November that he's up to the job and that he's kind of the saner, calmer alternative to Trump. That's the frame of the election to me, because then more people are likely to pull the lever for Biden, go the next yard if they get there. If they can't get there, then this election gets upended.
How difficult is that when people's frame of reference is already that they're concerned about his age? Our reporting from the G7 over the weekend was how other delegations were keeping a careful eye on Biden. They say he was very cogent when he jumped in on conversation about Ukraine. This is one source, but then looked a little bit to be zoning out when the conversation moved on. If that is already the base case, how much work does this administration really need to do?
Well, they need to do a lot of work to show to continue to show and have him show that he's up to the job. They can't do it for him. But a lot of these clips over the past week or so, as you were talking about earlier, are concerning. They're going to need to dissipate that, and Biden's going to have to be on his toes, not just because he's talking to an audience that's a huge audience in the United States and around the world, but also he's on stage with his major competitor, who's going to do everything possible to try to discombobulate him. So it is. I think he's up to the challenge, but there's a bar there that's not insubstantial.
You still think Biden is going to win this election. You do right when you talk about trying to define this election. Trump has his own issues as well. What is going to be his biggest test at this debate?
Well, I think that his biggest test is going to be, frankly, not going off the rails and coming in too hot. The joke around Washington last week while you were eating gelato was that, Trump comes to Washington and all of a sudden he's sounding reasonable in meetings with business leaders and with House Republicans. And, where did they put the other Trump guy? Trump's major problems are twofold. The Republican Party is split, as you can see from the Haley votes in the primaries, and Trump courting Haley, which legitimizes my point, and that he's not doing that great against or with independents. He needs to do both: consolidate the Republican Party, appeal to more independents in order to have a good chance to win. So he's going to have to calibrate himself in that way, and not worry too much about making Biden jumpy or feel worse.
Punchbowl has a great headline this morning, Terry. If it's Sunday, it's Trump VP Day, and you saw a lot of potential picks hit the airwaves yesterday. Where do you see the short list right now for the Trump camp?
I think, honestly, where it should be. I mean, I have no personal idea of what Trump's thinking. What it should be is Haley. Because Haley's the only one that unites the party and begins to make that independent appeal. I know there's some dissent about that even in polls, but point of fact is within the party and moving towards likely independent voters, Haley's the pick. And I think there's precedent for that, frankly, with Trump's pick of Pence in 2020. Not the same person, but in 2020, what Trump understood he needed to do was appeal to traditional conservatives who were somewhat put off by his, kind of all over the map performance. And Pence succeeded in that, both in the campaign and in the general election. So, anybody else other than Haley, I think is second best or third best. And, no offense to Senator Cotton, for example, or Senator Scott, but they're going to be on the campaign trail doing what they do anyway, being attack dogs anyway. So you don't really get that much out of having Cotton or Scott, let's say, be the vice presidential pick.
Well, Terry, you say it should be Haley, but what's the actual realistic probability of that happening? Because you had her very much so distancing herself from Trump. Even her so-called endorsement of him was basically just like, yeah, I guess I'd vote for him because he's the Republican candidate. They don't seem like two people who particularly like each other and would be willing to split the ticket.
But politics is full of people who don't really like each other yet making accommodations together. Haley's playing an interesting kind of rope-a-dope game, and Trump has been courting her over the past several weeks. There is a small window, I think, between the time in which Trump is sentenced in New York and the Republican convention starts that Haley gets to make a decision, and I think she's very much in the driver's seat on this. But the decision essentially is whether her political future is better off not only in the tent, but in the tent as the vice presidential nominee, or whether her preference is to stay out of it and stay aloof from the general election and try to pick up the pieces after she would think Trump loses. So it's going to be a very interesting next few weeks.
Terry Haines of Pangaea Policy, thank you so much. And next couple of weeks ahead of that June 27th debate on CNN, what are you looking for most of all, Anne-Marie?
I'm with Terry. I just want to see how they act. Does Biden look like he's up for the job and energetic? We've seen a lot of reporting. This is one of the concerns. And to his point on Trump, how does he try to look like potentially he is not coming in super hot and he looks presidential? Can they both do that?
Is it actually going to happen? You really think so?
Yes,
okay.
It's happening.
I don't know. There was a real question about that for a while. Coming up, not that. A slew of Fed speak on deck this week. ADP's Nela Richardson joining us next. Right now, you're watching Bloomberg. after a week of record highs, albeit with less and less leadership. It was really remarkable last week. Good morning. When we took a look at the NASDAQ, that was up more than 3% versus the S&P's almost 1.5% gain. 4 record highs. Today, we're pulling back just a touch. S&P futures lower by just 0.1%. NASDAQ, though, still up and really being punished. And Danny, this is what we've been focusing on quite consistently. The Russell 2000, it's damned if you do and damned if you don't if you're the small cap.
It's true. I mean, we heard it from Andrew Sheets of Morgan Stanley that finally bad news is bad news again. You would not know that from looking at the index because it is the mega caps, as you alluded to, Lisa, that are papering over. Finally, us being concerned about some level of slowdown in this economy.
Which raises this question of whether the bond market is really driving this, whether the two can diverge, and how much macro data is really going to undermine or has the potential to undermine what we've been seeing in the equity strength driven by those names. In the bond space, we saw a massive rally last week, a huge set of flows into, in particular, U.S. duration. We're taking a little bit of it back. The emphasis on a little bit, 423.44 on the 10-year. 2-year yields just hovering around that 470 mark, the 30-year 4.37%, but really just what a rip-roaring rally. And then you have to wonder, what takes precedence? The sort of hawkish message from the Federal Reserve and the slew of Fed speakers this week, or frankly, what we've seen in the data, which is true softening, true disinflation, and frankly, a growing concern that this is tipping over into something a little more protracted.
The bond market has taken its own narrative. It's not listening to the Fed speakers. It's not listening to Kashkari, who says, yeah, okay, maybe it's one cut in December and that's it. But again, I go back to this idea. We've fought the Fed before, and it didn't play out well. We fought them. We decided this was the year of the bond market. But because they weren't ready to cut, that play was wrong. So are we wrong again this time? Should we be paying more attention to the so many Fed speakers we're getting this week?
Yeah, or do you just basically, how do you fight the Fed or not when the Fed is not exactly a monolithic group with a particular group? You translate this through the FX channel, which you can see has been pretty consistent and dramatic euro weakening. And what we see today is a continuation of that around 107, a pretty significant pullback after what we saw with the French turmoil. And let's get to that. Under surveillance this morning, far-right French leader Marine Le Pen saying she won't try to oust President Emmanuel Macron if she wins the national election at the end of the month. Speaking to French newspaper Le Figaro, Le Pen saying she's not calling for, quote, institutional chaos, and that there would simply be cohabitation. So, Anne-Marie, cohabitation, what does that look like?
She says that she is going to be respectful of institutions, and I think you actually see that in the markets. It's starting to quell some of that concern. She has been vying for influence for decades, and she is on the cusp of getting it. So I think that's why she's coming out and saying, everyone calm down. She's trying to, I think, lean towards what Giorgia Meloni has been able to do in Italy, have far-right rhetoric, but at the same time be able to govern and be an actual partner when it comes to the EU. What this actually looks like is going to be, obviously, a disjointed government. And can a lot actually get done in that place?
Maybe that's a good news. Maybe that's good news for this market because you can't actually get anything done. So maybe the things she wants to push through, maybe it kind of looks like America. That really the worst that it can be for the deficit isn't that much. Because of inaction, because of cohabit. It's so French, cohabitation.
It is, but maybe America's looking a little more like France with a slew of cohabitation here as well. Meanwhile, shifting to regions, disappointing data out of China, the country's housing slump deepening in May, while industrial production rose, but at a slower rate than forecast. Retail sales offering some encouragement, picking up a bit more than expected, but still a real question, Danny, on whether you get the PBOC adding stimulus, what more they can do, and frankly, what's going to revive the slump that we've seen in the world's second biggest economy.
I mean, they've already laid a $350 billion plan to revive housing. Clearly, it didn't do that. But the PBOC didn't trim its rate this morning. Bloomberg Economics expected that they would, saying that they have an opening. They had an opening from the ECB cutting, from the Bank of Canada cutting. Therefore, they wouldn't have to worry about their currency weakening as much. But they didn't, Lisa. And maybe this is just a PBOC that is waiting for the Fed. Maybe they won't move until they do.
Also, other news out of China that I'm looking at, because we've been waiting for this retaliation. They said they're going to start, and this comes from pork imports. It's very tiny, but this could be the start of a more heated trade war with the European Union.
In terms of overproduction or something similar, overcapacity types of arguments akin to what Europe has been making toward China. So it's sort of, two can tango. We can cohabitate with an aggressive tilt together. A slew of Fed speak on tap this week. We'll hear from Williams, Harker, and Cook today. There are 6 more speakers tomorrow, plus retail sales data. On Thursday, more Fed speak, plus housing starts and jobless claims. Nela Richardson of ADP writing this: jobs aren't everything. Labor market data has been decent news, but as the Federal Reserve takes a wait-and-see approach on interest rates, we see big changes afoot on pay. Nela joining us now. And Nela, what I love is you can dig beneath the data at a time when it has been so confusing. Can you give us a sense of just sort of the sea changes under the hood that might be warping some of the overall index levels that we're tracking?
Sure. Well, good morning. It's great to be with you all today. I think what's interesting about this moment is that this is the most poked and prodded economy that I've ever seen. Every data point seems live and important, but it's sometimes a cacophony. And what we're looking at ADP, we're going through to what we think is most important in this economy, which is how companies hire and what they pay. And that has changed significantly over the last 4 years. We've seen shifts in geographic distribution, so people are commuting long distances. That has an effect on pay. In fact, we find in our latest report, it's out today, that people who actually go the distance for employment make 16% more than people on their own teams. So that's a huge change, and it's under-examined in this market. We're seeing pay distribution change, the gaps between the wealthiest workers and the lowest paid workers has grown by our estimate 5 percentage points over the last 4 years. We're seeing occupational changes where software developers, which should be an in-demand job with all of this talk about AI, there are fewer software developers now than in 2018. And then, of course, for all of us who have teenagers, summer hiring is in focus. The summer looks strong in terms of jobs, but not so strong in terms of pay for these young people. So all of these shifts feed into the narrative and the distribution of the worker, not something we talk about a lot.
And I guess that's part of the reason why the data has been confusing, because there are these structural shifts that doesn't necessarily show itself on a headline level. So what do we do with the data then? Should we just ignore it? Should we discount it because things are different and what it's telling us isn't really what's happening under the surface?
We can't discount it because we know that a certain really important institution is pegging a certain really important decision on the cacophony of data points. But that one move won't shape the economy. Whether you lower interest rates by one dip this year, 25 basis points or 2 or 3, really won't change the distribution of the U.S. workforce, which has shifted. And I think that's what we're seeing in the data. That pay change, this low level of wage growth that was really keeping the economy on track during the 10 years of expansion, is not here now. That pay is changing, it's evolving, and that evolvement in pay means that inflation may go up, may be higher for longer, and the Fed always has to be watchful on this data point and on pay in particular.
Consumer sentiment did not look good on Friday, and the director of the survey had this to say: the views of middle-income consumers resemble those of their lower-income counterparts, a departure from historical patterns in which their mentions are squarely in between those of higher and lower-income consumers. So what are you saying is that the wage gains are not on par with the inflation that middle and lower income individuals are feeling?
You know, what they're seeing is price levels. And they're looking at, yes, their paychecks, but they're looking at what's in their basket at the grocery store. And as long as there's a disconnect between how much their take-home pay has grown and how much their basket has shrunk, they're always going to be a little moody. Now, we've seen that a moody, bad vibes on the consumer side does not necessarily translate to lower retail spending. That's going to be something to watch this week. Last April, retail spending was flat. Those vibes have crept in. How long, how permanent they are, whether they affect spending is going to be really important. We've seen some resilience in the consumer, I would argue from the high-end consumer. They have been carrying this economy. So it's a really interesting situation that we're seeing in the pay when you take the pay and the retail side together. What you're seeing is that firms are raising prices because they have to increase pay from all those double-digit pay gains they've seen from low-paid workers. But the people who've actually benefited the most are high earners from asset prices, from higher wage gains. And so you have this combination, this cohabitation. I was trying to work it in. I was really trying to work it in. Between high spending, high earners and low income workers who are seeing high pay growth, but not able to spend at the same rates because of higher price levels.
I'm glad that you brought that up, Anne-Marie, that survey that came out and the commentary from what we got from the University of Michigan survey. It kind of raised alarm bells for me because it's atypical. Usually what you see is that middle-income workers kind of are in the middle when it comes to how they feel relative to the high end and the low end. They're not this time. They're shifting to the low end, and it raises this question, and it's been the big question for a lot of people. Are we seeing the beginning of a shift downward that's going to be a more protracted weakening in the labor market? Are you seeing that? Is this a problem for you that whatever it is, you can't reject people's feelings en masse, and so there's something going on that's going to potentially have a significant impact on the economy?
Feelings do translate into behavior. That's why we measure them. That's why they're important. And if you're seeing a diffusion of bad vibes, I'll label it that way, bad vibes through the income distribution, it doesn't spell good news for the economy. What I hear from Main Street is I'm delaying. I'm being like the Fed. I'm going to watch. I'm going to watch before I take on that new lease in my new car. I'm going to watch before I buy that investment property, that rental property. So that waiting and watching has an effect on the economy. So even if you can afford to spend, you may not do it this quarter because you're waiting.
So this is sort of the divergence between the bulls and the bears. Some people, I'm thinking of Andrew Hollenhorst out there, is thinking this is the beginning of a real weakening that we're going to see in the labor market. Last week's climb in initial jobless claims was a harbinger of a greater degree of weakening under the hood. Do you see that?
No. I think, again, that goes back to my comments about this economy being prodded a little bit. This is a normal economy. You're not going to make straight A's every quarter. You're going to have some weakness here and there. There's going to be weakness in pockets, but that doesn't mean that it's a persistent diffusion. What we're trying to figure out, and it's a hair-trigger decision, is when the Fed can feel comfortable cutting rates. That doesn't mean the economy is bad because they start cutting it. It doesn't mean it's necessarily good because they start cutting it. I think what it means is that the Fed as a whole, collectively, feels that they're a little more restrictive than they want to be in this particular normalizing economy.
So feeling better about the vibe session, maybe. But, okay, one of this idea, again, not to harp on this, but this idea of all of a sudden everybody's feeling a lot worse and the middle-income consumer, too. Jim Bianco, in looking at that UMich data, basically looked at it and said, there's been something strange happening with it. It's actually Democratic opinion that has really turned. I wonder if you look at it and say the same thing. Maybe what's actually happening is that political bias, but it's this huge cohort saying maybe Trump is going to be elected. So it's still that political influence, but on the other side, too.
It's hard to tell at this stage. We know that Mich survey has had a methodological change, too. It's gone online. We don't know if that changes the sample. We've seen, though, for the past 2 months, pretty downbeat sentiment. I'd be hesitant, though, given the changes that we've seen on the methodological end, to put too much on the political differences right now. But we know that politics does affect opinion, does affect vibes on the economy, and we'll see and should track how that plays out over the course of the next 6 months for sure.
Nela Richardson of ADP and a Bloomberg Television contributor, thank you so much for being with us, as always. Looking forward to next time. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with our own Yahaira Hackes. Yahaira.
Hi, Lisa. The Israeli military is beginning daily combat pauses along a key route in Gaza to increase the delivery of aid. The pauses run from 8 a.m. to 7 p.m. along the route and will be in effect until further notice. The army saying the moves are being coordinated with the UN and other agencies as humanitarian aid has faced major delays since the invasion of Rafah began in May. Deliveries have failed to reach their destination as they are sometimes intercepted by desperate crowds or seized by Hamas fighters. Bill Gates saying he's ready to throw billions of dollars into a next-generation nuclear power plant project in Wyoming to meet growing U.S. electricity needs. The billionaire telling CBS's Face the Nation that his energy company, TerraPower, relies on sodium cooling rather than water, which is believed to both simplify the process while also making it safer and could make nuclear energy a source of low-cost electricity. Gates says TerraPower's plant is on track to start producing power by 2030. And the season's first heat wave stretching from the Great Lakes to the Atlantic Ocean is set to raise electricity demand and slow transportation networks. Here in Manhattan, we're set to reach 91 Fahrenheit on Tuesday and steadily get hotter through the week, with humidity making it feel closer to 100 degrees, according to the National Weather Service, which also said some areas could experience the longest heat wave they've seen in decades. That's your Bloomberg Brief. Lisa?
Thank you so much, Yaira. Up next, is this a Liz Truss moment?
Drawing comparisons between what could happen in France versus the mini-budget crisis in the UK in 2022. Is anyone proposing some degree of fiscal consolidation right now? And it doesn't sound like it.
So basically someone in the control room is trolling me. But that's coming up next. You're watching Bloomberg. Into a new week, really kind of moribund when it comes to where markets are. It's been anything but, though, last week, really climbing to record high after record high, but on a fewer and fewer cohort of names, all tied to the AI trend. What we're seeing right now, pulling back just a touch from the 5,500 mark on the S&P at the same time that you have the likes of Evercore ISI looking for 6,000 at year end. Euro gaining just a touch, basically wavering here around 107. 10-year yields up just marginally about a basis point to 423, and the crude levels you can see just lower by a touch. I want to watch this, though, Anne-Marie, given the fact that we're seeing that increased demand due to the heat wave.
Yes, and also Amos Hochstein overnight talking to the FT, talking about the fact that they will step in if they see gasoline prices go higher, alluding to the fact that they could tap the SPR again. Election strategic petroleum reserve, as Jonathan would say.
All right, well, we can talk about that extensively right now. Under surveillance this morning, the moment we've all been waiting for. Is this a Liz Truss moment?
It doesn't really matter in terms of if it's a left coalition or right coalition. The fiscal policies are worrying. Drawing comparisons between what could happen in France versus the mini-budget crisis in the UK in 2022. I've heard a lot of questions from clients about that as well. Those are the scenarios that people are talking about. So beyond the headlines, let's have a look at the policies. Is anyone proposing some degree of fiscal consolidation right now? And it doesn't sound like it.
Here's the latest. The euro coming off 6-week lows ahead of snap elections in France later this month. Far-right leader Marine Le Pen making an appeal to moderates and investors, saying she won't try to push out President Emmanuel Macron. Instead, it'll be cohabitation. Polls showing her party holding a lead with 35% of the vote, with Macron's party polling third at 19%. Joining us now is Elsa Lignos of RBC. Elsa, do you think that the risks are sufficiently priced in of potentially Euro anxiety, the idea that there could be some sort of shift away from the collective region by a major economy, namely France?
It depends which market you look at, to be perfectly honest, because the spot market has barely budged. Yes, euro is a little bit lower, as you mentioned, but that's really euro dollar. If you look at euro yen, still very much near the highs. Euro Swiss has had a decent move, but only really back to levels where we were in February. The vol market's been pretty different. You know, I think tail end of last week, you saw a lot of interest from investors to buy some euro vol, to put on some downside structures. But even that, you know, Monday, given the news over the weekend and Marine Le Pen saying she'd work with Macron, not looking to push him out, investors are already fading those moves. So to answer your initial question, is it priced in? No, clearly the worst case scenarios are not priced in at the moment.
Potentially, though, we could see a hung parliament. In that case, Elsa, do we just go sideways in terms of euro trading?
It's very possible, and I think, frankly, that's why people are struggling to pile into short euro-dollar positions at the moment. The fact is that we have seen cohabitation before in France. You know, we haven't seen it in this kind of setup, whether it's the far right or the far left that wins. Both have fiscal policies that are pretty extreme in some cases. But the reality is that we've been here before in the euro area, and every time you kind of investors sense there may be some crisis down the corner. We saw it with the elections in Italy when Meloni won. It doesn't ever really pan out, and I think that makes people nervous about putting on positions, having seen it not work so many times before.
Well, Elsa, if that's the case, and it's unlikely to be anything disastrous when it comes to a deficit, let me put this idea to you, that what we're seeing from the market is they are simply trying to test the ECB. They want to see if the ECB comes in and caps spreads like they did when Meloni was elected. Is that what it is? Bond vigilantes pressing Christine Lagarde and co.?
Yes, it's definitely true that you've seen more of a reaction in the fixed income market than you have in the FX market. And part of that is, to your point, markets pushing the ECB to see where's their limit. I mean, the fact is, we heard from ECB officials over the weekend, this is a repricing, and to some extent, they're quite comfortable with investors repricing a higher risk premium for France because that is part of the market mechanism. Now, if it looks like it's getting out of control and, it feels like the market is getting dysfunctional, then you may expect the ECB to step in. But otherwise, I think the ECB are going to be quite reluctant to rush to the rescue.
But what if it starts to seep into Italy, to Spain, to other countries where we start to worry about fragmentation, where we worry about their deficit levels? Could the ECB then act?
Absolutely, but that's not really what we're seeing at the moment. I mean, in fact, a lot of the observations people were making on Friday was precisely around the fact that France was trading through certain other countries. When France is trading through Spain or Italy or so on, that in itself tells you something. It tells you that people have reassessed how they're perceiving the risk of French fiscal side. And it's not so much about France exiting the EU. I don't think anybody, that's obviously a terrorist that people have in the back of their minds. But this is far more about the fiscal agenda and what's going to be the policy in terms of fiscal outlook.
Elsa, what I find fascinating about your recent research is you kind of get the sense from you that maybe you think the dollar should be stronger than where it is. That all things being equal, given the uncertainty in Europe and given what we're seeing, which is a pretty resilient economy in the U.S., the AI tailwind, the idea that people are taking weight loss drugs and getting new clothes and spurring a new boom there, whatever case, you should see kind of dollar preeminence. Why do you think we're not seeing an even stronger dollar? What do you think that suggests about where people's minds are at?
I mean, to some extent, you can see that bias in our forecast, but frankly, I've had 106 as a kind of low for this year. I haven't changed it. I still feel quite comfortable with that number, which is not a long way from where we are today. And 108 on the other side, it's really very much a range trade. Part of the reason I think people are reluctant to pile into long dollar positions is because there are some questions out there around the strength of the US economy. It's not our view, but there are some people out there who are saying, we're seeing some cracks begin to emerge. And if the US were to hit recession, I do think euro-dollar would be quite a lot higher. And it's that uncertainty on both sides, political risk on the one side, uncertainty around the strength of the economic data on the other, and the fact that we've already priced in a very good US economic outlook. And so, the risks on the economic side, at least, are to the downside for the US.
When it comes to the dollar, investors are still split on what a Trump presidency would mean to the dollar. Why?
It's a great question. I think in part because Trump himself is so ambiguous on what his policies would be if he were elected. You can expect that he would make a lot of noise around the Fed, push the Fed to be a lot more dovish. But I personally question to what extent he could really force the hand of the Fed. He can't nominate a president or a chair, for a couple of years. And on the flip side, there's a lot of talk around America First, around tariffs, around how much more aggressive tariffs could be in a second Trump presidency. And that leads people to think the dollar would strengthen, other currencies would weaken. So you can see how on both sides there is, a push and a pull. Where I do think markets are perhaps overly worried and maybe need to tone it back a bit is the long-term deficit outlook. Yes, it's something we need to watch, but from the dollar perspective, as long as the US private sector is running a surplus, that's much less of a currency story than some people make it out to be.
Elsa Lignos of RBC Capital, thank you. So it sounds like, Danny, she's not completely on the Liz Truss moment side, if it doesn't seem like she's,
climbing into the oil, the deficit camp.
True. I still really like this argument. I'm going to be honest. Robin Brooks put it forward that what we are seeing is not a market that thinks it's going to be a Liz Truss moment, but wants to test the ECB. That the ECB let the cat out of the bag in 2022 when they stepped in for Italy's election and helped to cap yields. But then you get to this uncomfortable space where if they do that, then are they interfering in politics? Are they making a Le Pen government more palatable?
So a Christine Lagarde moment. We can get there. Coming up, Citigroup's Stuart, Kaiser, Bloomberg's Wendy, Benjaminson, and Enda, Curran, as well as Kelsey, Berro of JPMorgan on a day that we are leading into a week of Fed speak. It is full-on Fed speak week. This is Bloomberg.
People are chasing, right? They're chasing those winners and continuing to feed into it.
I think the haven trades are places where earnings are happening. Tech companies.
You have to be there. This is a story, and while these stocks have been great, they're still not ridiculously priced.
Equities are closer near term to being fully valued.
It does seem like there's a little bit of caution around just how much markets could be priced to perfection.
This is Bloomberg Surveillance with Jonathan Berro, Lisa Abramowitz, and Anne-Marie Hordern.
Caution, but still upgrading forecasts for year-end. Good morning. This is Bloomberg Surveillance. Anne-Marie is back in the hot seat. John Farrow off, but Danny Berger, we're very glad to say, here for all 3 hours and throughout this week. Right now, we are coming into a week after 4 straight record highs on the S&P, on the NASDAQ, led by a small cohort of stocks. And this morning, Danny, coming in to a number of upgrades from a lot of shops that say, hey, listen, just because it's narrow leadership doesn't mean it's going to end.
Exactly. From Goldman Sachs, from Citi, from Evercore. Evercore's, I think, is interesting because Julian Emanuel is essentially arguing this is just the first inning of an AI boom. But that basically argues that you're going to have to see more cooperation from different non-traditionally tech companies. Is that really the case? Is the AI boom going to spread more widely to different industries?
Which raises this question, what could potentially shatter the confidence that people have that NVIDIA can keep cashing in with the leather jacket and the godfather of AI, as we hear from Dan Ives? Or is this really going to be something that's fragile, especially in light of some of the risks coming down the pike? How vulnerable do people feel, Anne-Marie, when you were over in the southern Italy eating great food and soaking up the sun?
Vulnerable about politics, not so much vulnerable about southern Italy and all the hospitality it has to offer.
All right, okay.
But when
I heard
you
this all
look
last
at
week.
actually people raising their S&P 500 targets, where else are they left to go? Remember that whole idea of, well, we're going to look at Europe? Europe's kind of a mess right now. The European parliamentary election showed that. The UK is on set for an election, and Macron is set for an absolute bruising upcoming. Sure, maybe Marine Le Pen talking about cohabitation is starting to quell some of the French markets, but there is serious concern in what Europe is going to look like.
Okay, you just wanted to get cohabitation in, because basically we've been talking about it throughout the morning.
I want it to be the lead of your note. So I'm trying to
just keep going, cohabitation, because that is what Emmanuel Macron and Marine Le Pen is. It is evidently a formal term in France about the party of the president and the ruling underbelly not being of the same party. It does not reference anything else. Danny, this does go, though, to this question of American exceptionalism and how much is it just simply that there is no other better place?
This is what I'm trying to make work. It's not American exceptionalism. It's Europe exasperationalism. I don't think it's a word, but I'm going to attempt to make it work. But yeah, there's nowhere else. You look at the China data, that's not great either this morning. You have to reside within the U.S. But at what point are we not saying anymore, Lisa, it's residing within the U.S.? It's just AI. That's the exceptional trade.
And is that enough? And that's what we've kind of heard from a bunch of places. This morning, it's not quite enough, although if you look under the hood, guess what's still up? Although very small, you do see the NASDAQ with a little bit of a lift, even though the S&P is lower. When I say little bit, I mean little bit. Basically, the S&P hovering just a notch away from 5,500. You could see euro gaining just a touch versus the dollar after a real bruising week last week, 107.12. Remember, we were well through 108, and we have come down dramatically in the face of some of the uncertainty in France. The 10-year yields just taking back some of the gains that they saw last week. We saw a huge rally. Now we're seeing 4.24 if you round it up 1% on the 10-year, and crude just lower by
blip, but basically flat, $78.44. This is what we have on deck ahead of a slew of Fed speak, as well as a 20-year Treasury auction later this week. Coming up, Citigroup's Stuart, Kaiser, and whether the U.S. equity winning streak continues, Bloomberg's Enda, Curran as China's housing slump deepens, and JPMorgan's Kelsey, Berro as Minneapolis Fed President Neel Kashkari urges patience on rate cuts. We begin with our top story, futures on pause as traders kick off a holiday-shortened week. The team over at Citi raising U.S. equities to overweight from neutral. Stuart, Kaiser of Citi keeping a cautious approach, writing this. At this point, a broadening trade seems limited to a soft landing scenario. What has worked better are larger cap and safe stocks that have equity beta, but less exposure to recession and refinancing risks. Stuart joins us now. Stuart, great to see you.
Morning.
Happy Monday. How vulnerable is this market, given how narrow this leadership has gotten?
It's funny because a couple weeks ago, it felt really, really vulnerable, right? You know, pre-payrolls, I think people were talking about recession risks and how this could kind of derail the rally. And then, a strong payrolls report, a friendly CPI, and everything is sort of hunky-dory again. So, the narrow leadership is an issue, especially because I think the market's tried to broaden out the AI theme a couple times this year. And each time it's sort of failed to some degree because there are just so few companies that can actually demonstrate revenue related to AI. So I think there is an underlying risk just that folks have gotten so bullish about the AI theme. They've tried to apply it to other areas of the market. And I think that's the bigger risk. Obviously, with NVIDIA, just this series of huge beats to consensus, eventually that has to kind of run its course as well. But I think the bigger risk here is people trying to apply AI more broadly and then sort of getting tapped back to the middle by that.
And that's actually what I saw in a lot of notes. Lori Calvasina coming out and saying this record divergence between large caps, particularly the AI drivers, and small caps, but still stay underweight some of those small caps because there is this vulnerability. You talk about three scenarios: hard landing, higher for longer, and soft landing. How do you weigh the probabilities? What do you have to see before you start believing in a broadening once again?
Look, I think the probability is exactly right. We get a lot of questions. Is this the time to own small cap? Is underperformed by so much, by historical standards. And our point in the note was you have to assign a reasonably high probability to this soft landing outcome to really have the confidence, I think, to buy that smaller cap stock. And if it's 10 or 20%, that's probably too low a chance. And the more you talk to clients, I think that outcome has been narrowing as the year has gone on, right? Because we just saw a slew of data, whether it was downward revisions to 1Q GDP, Chicago PMI, ISM. There's been a lot of sort of shots across the bow on weakening growth, and I think that's just made people even more and more reluctant to kind of take the step into that smaller cap.
And that's what Mike Wilson, Morgan Stanley, talks about, that weak growth that is starting to seep into the market. It's this irony that both he and Julian Emanuel can be correct, that you can have a market that reacts to weak data and AI supporting us. But to your point of the AI trade widening out, JPMorgan's Eduardo Lucabari basically says that for equities to avoid a 20% correction, you have to believe that tech will become a much more meaningful driver of growth for the broad economy in short order. Would you go that far as to say that?
No, I don't think that's the only thing that's preventing us from a 20% drawdown. But, clearly the AI theme has been applied and it's almost turned into a macro story, right? That this is going to create, higher productivity in workers and you're going to get a GDP growth that is this higher than you might have assumed. GLP-1, which we've talked about, also kind of fall in that category. So, yeah, I mean, there are some big assumptions being made about not only how profitable an NVIDIA or a Microsoft or pick your AI software stock could be, but also what does this do to kind of longer-term trend economic growth, and what does that do to your kind of long-term view?
Do you buy that it will lead to that?
We're going to have to see. I think the challenge for me on AI, one is there's only a small number of companies that are demonstrating they're able to generate revenue. So is the flip side of your argument that we're just going to see large cost reductions and that allows kind of a longer runway for growth related to AI? I think that remains to be seen. AI as well, companies have been using forms of AI for a while already, right? That annoying chatbot you deal with is what people are now calling AI, right? So, we're not going from zero here. And I think to some extent that does mean we're going to have to wait a little bit to see either A, the revenue demonstration, or B, confirmation of the cost reduction.
For a while, people were talking about potentially starting to broaden out, look at Europe. Now you're writing that you see a lot of risk premium being built into what's going on politically. Mm-hmm. What are you seeing in terms of European equities?
Yeah, I mean, the vol in Europe just, spiked massively last week. You're back to levels we haven't really seen since the European debt crisis in 2015. The U.S.-Europe trade is tricky from a lot of different directions. I mean, the U.S. is large cap tech and growth. Europe tends to be a little bit smaller cap, more value, more cyclicals. So you have like a lot of like factor risk that people are dealing with. It's funny that people in Europe are looking to the U.S. and say, hey, we wish we had that political scenario, right? I mean, that's if you're living here, that's sort of a surprising conclusion to draw. So, I do think, particularly in European banks, people tried to engage on the long side in European banks. That positioning has come out pretty quick, with what's going on in France as well. So, look, I think for Europe to work, I think the U.S. does have to broaden out, if that makes sense. Like, you need people willing to take more risk in the U.S., buy that smaller cap value cyclical. And once you're doing that, then you start to make this relative valuation debate between the U.S. and Europe does look cheap, right? So that can kind of lead you down that path. But I think it's a gradual path, and I think people are going to be pretty cautious about following those breadcrumbs.
So do you think this is overdone?
The pullback in Europe? Hard for me to say because I think it really depends on what happens, in France. And I think there's reasonable concerns about the fiscal outlook in France. Obviously, we have reasonable concerns about the fiscal outlook here. So if you're getting really concerned, you're seeing some German swap spreads and some of these other liquidity metrics kind of dislocate. You have this sort of latent fiscal risk under the surface that if it gets triggered becomes a major issue again. So I don't know the European market well enough to be brave enough to step in. So for now, it's we're gonna step back and look. It doesn't feel like 2015. So in that sense, it does feel like tactically we've probably priced a little too much risk. But those are famous last words. So I'm just going to stay with large cap growth in the U.S.
On the margins, though, does this basically send more dollars back to the U.S. and basically leave you in the same place where we saw Julian Emmanuel, which is 6,000 by year end?
Well, I'm not going to make the 6,000 call, but to me, 6,000 call is you need a soft landing outcome to get there. But yeah, look, it just reinforces the idea that the U.S. is sort of the cleanest, kind of safest place to invest. And, we have really deep equity markets. So if you want a risk that looks like Europe, you can find that with U.S. stocks. If you want a risk that looks like EM, we've got some nice small cap for you. So I think a lot of people are just saying, I'm going to express those risks in the U.S. a little more directly. Yeah, I think it does help the exceptionalism narrative a bit.
What do you make of this Peter Shearer argument that Lisa was talking about this earlier? The big swings that we've seen in stocks, specifically mega caps, is a sign that liquidity is really bad in the American equity market.
It doesn't feel that way. I agree we've seen some big moves. But if you look at in the last 10 days, we went from trading recession to higher for longer to soft landing in like a 4-day period. So, is it a lack of liquidity or is it the fact that the narrative is changing a lot and the data is unstable and people are being kind of very reactive about that uncertainty? Certainly I think the U.S. equity markets are still pretty healthy. I haven't looked at the data he's looked at, obviously. But no, I think it's summer, things have quieted down a bit, but I just think the incoming data has been unstable enough that has kind of reflected itself in the instability of the markets themselves.
Before we let you go, let's talk about weight loss considerably. That you said GLP-1, and I thought there was a fascinating story over the weekend. The Wall Street Journal talking about how a lot of retailers are seeing a real increase in shopping from people who are using some of these weight loss drugs, in particular for tight-fitting clothes, and they've changed some of their looks. How much could that be a broadening out kind of trend? We've been talking about this and that this is sort of the new AI. At what point do you see that?
It's a great question. I mean, the bigger discussion we've had about GLP-1 is sort of labor force participation and things of that nature. So it's possible you get a job, you have to buy more clothes. I thought those drugs made you really depressed too, though. So I'm not exactly sure what people are shopping for.
Stuart Kaiser on GLP-1s, Citigroup. Thank you so much for being with us. Looking forward to the next time. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. European markets continuing their volatile streak amid uncertainty in France. This coming as Citigroup strategists downgraded the region from overweight to neutral, citing the risks from a potential far-right majority in France, as you were discussing, in the upcoming parliamentary elections. But French far-right leader Marine Le Pen did soothe markets earlier, telling a French newspaper she'll work with current President Emmanuel Macron if her party wins the elections. The number of voters here in the U.S. who say they don't like either major party presidential candidate is at a historic high, according to the Pew Research Center. The amount of double haters, as they're called, make up 1/4 of the electorate. That's nearly twice as many as this point back in 2020. Double haters were a key factor in Donald Trump's upset win in 2016 when they broke for the Republican candidate over Democrat Hillary Clinton. The biggest threat to Biden and Trump is that voters will stay home or vote for an independent candidate like Robert F. Kennedy Jr. And for the first time ever, a Deadpool movie will open in both China and the U.S. simultaneously. Disney has announced that Deadpool and Wolverine will be released on July 26th in mainland China with, quote, minimal cuts. Previous Deadpool films saw no release to months-long delayed releases as the R-rated movies face scrutiny and censorship from China's Film Bureau. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, inflation in the crosshairs for President Biden.
Over the last roughly 3 years, there's been a significant increase in the price level. So it's something the Biden administration absolutely wants to address.
That's coming up next. This is Bloomberg. Coming into a week without an incredible amount of price action. Last week, though, was anything but, with a massive rally in the bond market. And what you saw was 4 record highs on the S&P 500, just kissing that 5,500 mark on the S&P, down less than a percentage point, with less than 5 basis points. What you can see is the euro just a touch stronger after a real bruising week last week, 107.11, and 10-year yields up just marginally, but really not that significantly considering the huge rally that we saw last week. Under surveillance this morning, inflation in the crosshairs for President Biden.
Over the last roughly 3 years, there's been a significant increase in the price level. It's now rising at a very slow, close to normal rate. But yes, Americans see that, and mainly it comes on top of concern about costs that were making life very difficult. So it's something the Biden administration absolutely wants to address.
Here's the latest. The Biden administration ready to respond by tapping the Strategic Petroleum Reserve. In an interview with the Financial Times, Biden's top energy advisor, Amos Hochstein, saying the administration will do everything it can to bring down gas prices this summer as the election grows closer. Anne-Marie was talking about this earlier. Joining us now to discuss is Bloomberg's Wendy Benjaminson. Wendy, what is the threshold? Do we have any sense for the administration to take action and tap the SPR?
Good morning, Lisa. I don't know if there's actually a dollar amount threshold, but there will be the point where you'll start hearing voter complaints, or Donald Trump will start capitalizing on it, or people will get reports of people canceling summer road trips or things like that. And that's when the Biden administration might respond by releasing more from the Strategic Petroleum Reserve. But of course, that also engenders a lot of Republican pushback, which will show up in ads that he is tapping a reserve that is supposed to be there for emergencies that are not just political.
We do see, Wendy, and I know you leave our polling coverage, we do see continuously in the polls that the economy and inflation weigh on the American electorate. What does Biden need to say at this debate to try to ease some of these concerns? We heard from Janet Yellen over the weekend. I'm not sure that's doing the job.
Right. I don't think it is, Anne-Marie, although I do think there's been a slight, very subtle shift in their messaging where they are at least beginning to acknowledge out loud that prices are still too high for consumers. Because, we see on the terminal, and people who follow financial news and economic news very closely will see that the rate of inflation is coming down. The Fed might lower interest rates at some point this year. But most voters only know inflation from the gas pump and the grocery store. And those prices are not as high, or much higher, than they were when Donald Trump was president. And a lot of people just see that as an equivalent and need Biden to show that he's doing something more about it. But at least their messaging has shifted. You heard Janet Yellen say, the prices were still too high for consumers. And Biden's statement celebrating the CPI last week also was, the first sentence was, prices are still too high. So I think they're beginning to shift their messaging, at least, to try to get past this.
We also saw some strong fundraising numbers from the president over the weekend. $30 million the campaign said he brought in from the star-studded event in Los Angeles. But Wendy, he's bringing in the likes of George Clooney, some of the older stars. He's struggling when it comes to the younger cadre. Why?
In a word, in 3 words, the Israel-Hamas war. I think that is really dragging down Biden's popularity with young voters. They are still very upset that the U.S. still supports Israel so fully in the execution of its campaign against Hamas and Gaza. I think there's also, although he can show that he is cogent and on top of things, he comes off as really old. He tells dad jokes. And I think that the younger voters just don't feel like he's on top of what they see as the problems in the world.
I, for one, love a dad joke, Wendy, but that's not for me to decide. It's not just the younger voters that have drifted away over Israel-Hamas. It's also the billionaire class, Wendy. You look at Steve Schwartzman, some of that ilk who have now publicly started to back Trump and fundraise for him, where they've stayed out of it before. How big of a blow is that to Biden and his campaign?
It could end up being a blow in a close race because if Donald Trump, who is having trouble raising money without people like that, because, his base are not the richest people in the country, and there is a limit to how much they can contribute. If the billionaires can now contribute to his super PACs, either paying for legal fees or campaign funding, then, that could give him a real boost while Biden can still get the establishment Hollywood money. Almost quid pro quo that Donald Trump is offering them is he is being very, very straightforward about it. If you fund me, if you get your friends to vote for me, I will work to lower taxes for corporations and the wealthiest Americans. And that is the 180 degrees the opposite of Biden's message. So, when they're looking at the bottom line, Trump may look like a better bet for them.
He also says, though, that he's going to fund it through tariffs. And there's some question as to whether that actually is feasible. Janet Yellen, we've been talking about her interview, basically saying that tariffs would have to be 100% to really make up the difference. Does the business community not care, Wendy, or are they hesitant on that sort of idea of how this actually gets done?
Honestly, I think people, the billionaire class actually feels they may be able to get to him and reason with him a little bit on some of it. He has talked about 60%, he's talked about 40%, he's talked about 100%. He's sort of all over the map on it now. And of course, this would have to pass Congress. So there's a lot of work to be done to still get to those tariffs. But the effect of those tariffs will be higher prices for American consumers, hitting hard the most Trump's electoral base.
Wendy Benjaminson, thank you so much for being with us of Bloomberg News. I have to say, this has been one of the most interesting aspects of this whole recovery, which is we don't really understand the full effects of all of the fiscal spending. This from Torsten Slok of Apollo over the weekend, saying the positive effects of fiscal policy dominate the negative effects of Federal Reserve rate hikes. And we saw that in terms of the economic data and just this, incredible line going straight up, asymptotic line, when it comes to economic growth, despite the rate hikes that we saw. And Ray, do you have a sense of whether there is any restraint being proposed on this fiscal spending? How much still has to be unleashed in the economy?
Well, it's an election year, so no. And whether or not it's Republican or Democrats, you're going to see spending. It's just going to be different. I was struck this morning from the Committee for Responsible Federal Budget, putting out some numbers. Trump last week was proposing potentially exempt tips from taxation. They say that would add between $150 billion to $250 billion to the federal budget deficit over 10 years. On top of that fact that potentially people are also talking about tariffs being inflationary and adding to the federal budget deficit. And what does that mean for the Fed? It is why it's so hard for the Fed to predict 2025. They don't have all the information ahead of them on what actually the fiscal policy is going to look like, because it's very different, even though there's going to be more spending, but it's very different whether or not it's Republican or Democrat.
Well, part of the issue, though, is it's the trajectory we're talking about, right? It's the trajectory that we're really worried about. At its current level, perhaps it's not concerning. So you really need this forcing event. Just saying maybe sometime in the future it's going to be a problem isn't enough to get this political action. So what do you need? Maybe you need an economic event. You need Canada a la 1990s to say, OK, this is really bad and we step in. Or is it political? Is it insolvency of Social Security or Medicare? But again, these are things that are far away, and it is not action that would happen now.
It strikes me, and I'm kind of thinking aloud, but the issue is, if there is a downturn, what's the fiscal lever? Is the monetary lever of lowering rates from a relatively high, relative to the past 20 years level, enough to offset the lack of fiscal potential if the deficit becomes a potential headwind to raising more money? These are some of the questions that people have that, frankly, don't have answers at a time where the U.S. is the cleanest shirt in the room. You were pointing at this before, Danny. I mean, where are they going to go instead? France?
Certainly not.
The cleanest shirt in the room, but it has stains. This is the problem.
France is, maybe we want to cohabitate with France. I don't know. I'm not sure.
And maybe our cohabitating partner can take it to the cleaners. Coming up, disappointing data out of China. We'll be discussing that, less of the cohabitation right now in markets. Not doing much, although really you're still seeing that divergence between small caps and the mega cap techs still eking out the wins. This is Bloomberg. Into a new trading week after seeing a slew of record highs last week. Hard to find real action this week as people look ahead to, yes, Fed speak galore. You can't get enough of it, but also some key data. And this actually is something we haven't talked enough about. The fact that we get retail sales tomorrow really is key at a time where people are trying to understand whether the weakening in economic data speaks to something deeper or just simply a normalization. NASDAQ futures, I want to pick up on this, up about 0.2%, even as the S&P is pretty much unchanged. The Russell 2000, not surprisingly, down almost 0.2%. Danny, how much are we seeing this divergence continue, frankly, in the notes that we got over the weekend with strategist after strategist saying, frankly, this isn't going to change unless some dramatic shift in the economy happens?
Again, I get back to this irony of you can have a world where Julian Emanuel of Evercore says we're going to 6K because of AI, and you can have a Mike Wilson saying we're more sensitive to weak economic data, and both are true because under the hood, it is a record divergence between the S&P and to equal weight. Something has changed where bad news is only bad news for the rest of the market.
And that something might have to do with the bond market. What we saw last week was a huge rally, a huge bid into the U.S. government bond market as people took a look at a softening in inflation data, softening in broader economic data. And what you saw, even with auctions, people flooded into U.S. dollar bonds. Today, you're seeing a bit of that taken back, but still lower across the board from last week, up about a basis point for the 2-year and the 10-year, up about 3 basis points for the 30-year. I just wonder why this isn't benefiting that huge rally in the bond market. Why that isn't benefiting some of the smaller companies that sensibly were more levered to the potential of higher rates, and we're supposed to benefit from them coming down.
Well, one argument I've heard is that the small cap companies have a lot of floating rate debt, so you need something really big to come down, and so you need to see, look, the rate cuts. You need to see the whites of their eyes before you can actually trade the small caps, just because we are concerned about refinancing, and maybe if it's Neil Kashkari world and it's just one cut in December, that isn't enough to remove the maturity wall concerns.
Meanwhile, you're seeing a fluctuation in the currency space when you look at the euro versus the dollar as people reassess after the big sell-off from last week. Turn to green, a little bit stronger of a euro versus the dollar, a little bit being the operative word, 107.15. Under surveillance this morning, Minneapolis Fed President Neil Kashkari saying the central bank is in a good position to take its time before cutting rates. His comments coming ahead of a busy week of Fed speak, that is an understatement, as well as U.S. retail sales data. I just wonder how much we're seeing Fed officials really kind of speaking out of all sides of their mouths and us not seeing any kind of consensus whatsoever on the FOMC.
Maybe this is why we need to trade the data. We need to ignore the Fed because for the first time in a while, the Fed's not in cohesion. It's kind of a healthy thing, though. It's kind of nice to hear, isn't it? Some actual disagreement among FOMC members.
I was struck by also what Neil Kashkari said in that interview about primacy of the dollar. He sort of talked around this when he was asked by Margaret Brennan about the G7 coming out, tapping Russian assets, highly controversial. He said the dollar's responsibility ultimately lies with the U.S. and understanding people would view the dollar, given these types of move, that's really for them to decide. Really didn't want to weigh on the controversy and the politics surrounding what this potentially means. A lot of people say this is de-dollarization and potentially de-eurozation.
Although it speaks to a larger point that Neil Kashkari has spoken about, even on Bloomberg Surveillance, where he's talked about why he doesn't see a Liz Truss moment. At the end of the day, the dollar still is the gravitational force. And frankly, last week we saw that with a lot of questions around what would happen in France, what would happen more broadly with the swing in the elections that we saw in the Euro region. Want to shift gears a little bit. No pun intended. Shares of Tesla are rising after the EV. So good, it's bad. The EV maker was granted approval to test its advanced driver assistance system in Shanghai. This, according to a person familiar with the matter, it's the next step in rolling out the feature to Chinese drivers. This is so interesting to me, Emery, because this comes at a time where Tesla is kind of walking a tightrope, where their sales depend on China at the same time that the U.S. is blocking out EVs from China. Europe is raising tariffs on EVs from China,
including Tesla.
And it raises this question of how he plans to play this. What's this sort of giving you a sense of?
He clearly wants to get this robo-taxi to hit the ground running, no pun intended. But the problem is he has a lot of regulatory issues in the United States. Remember that trip he made? Out of the blue, it felt like that Sunday he went immediately to China, and then all of a sudden we saw potentially this regulatory approval for this. Now they're starting to actually hit the ground running, and we're starting to look like he's actually putting this robo-taxi to test, this self-driving car to test. It's going to be happening in China.
And is this almost a rhetoric campaign by China to say, look how far advanced we are on EVs. You might have new tariffs coming from Europe and coming from the U.S., but look at this. We're letting Elon Musk test his robo-taxis. I'm also going to do a John Farrow thing because he's out, and I did watch the European soccer over the weekend. BYD was a huge sponsor. Literally everywhere you looked, whether you're watching Germany, whether you're watching England, you see BYD plastered over something. There feels something to this. Like China is really trying to use rhetoric, winning the hearts and minds, rather than just retaliating with, I don't know, a pork tariff. Just not massive.
Want to tell you, doing a John Farrow would be calling it football. He would never call it soccer, but that was a good try.
It's a great point,
You
Lisa.
didn't mention Italy and their beat over Albania.
Okay, I didn't pull a Farrow.
but who's counting?
Yeah.
Let's talk about China. Given the fact that we got some data over the weekend, China's housing slump deepening in May, home prices and real estate investment declines gathering pace. Industrial output also disappointing. Bloomberg's Enda Curran joins us now. And I want to just start with the data that we got overnight. There was a real feeling that maybe we would get a turn, and we did marginally when it came to retail sales. How negative was this, considering that industrial production really disappointed, and the housing market, yet again, we saw that we're not seeing a floor in home prices in China?
I think that's the key takeaway, Lisa, with the data on the housing market. Like you mentioned, new house prices falling by the most since 2014, new investment the weakest since 2020, and that's despite the measures announced last month, 42-odd billion worth of money made available to mop up unsold homes, on top of measures to bring down the cost of a mortgage and other incentives to try and get the housing market rebooted. So it looks like that's not yet gaining traction. I mean, it's only 1 month, of course, but it lends itself to the idea that economists say it's not enough, more needs to be done, and the rest of the world has been looking at China's real estate sector for when it turns a corner. That data suggests it hasn't yet turned a corner. We did, as you mentioned, have better numbers on the retail sales side of things, picking up a little bit there, but still well below the pre-pandemic trend, speaking to this idea that the almighty China consumer engine that used to power global growth in the previous decade or so isn't back to where it was. And to kind of illustrate just how complex things are for China right now, the central bank held back from cutting rates despite the growth story, and that's because they're trying to keep some support under the yuan, under the currency there, and they can't really move yet until the Fed makes a first move. So overall, it's a pretty downbeat picture on China's economic data. It lends itself to the idea that more support is needed if the government is going to hit that all-important 5% growth target this year.
And it used to be that China's problems were the world's problems, and that any time that China was slowing down, this meant a huge problem on growth in Europe, as well as in the U.S. Increasingly, we've seen the U.S. more immunized from Chinese economic woes, Europe less so. But how much does it really matter if their economy doesn't get off the ground and continues to really struggle?
I think, yeah, broadly speaking, the growth baton has been handed to the US, Lisa, no doubt about it. You saw the World Bank upgrading their forecast last week, mostly in the back of what's happening in the US. And the US consumer has been powering the global export recovery over the past couple of years. So China is playing a diminished role. Obviously, it's very important still sector-specific. For example, the spending on infrastructure is very important for the commodities markets, commodities exporters. Look at the price of iron ore, for instance. And, of course, the consumer story on the ground, even though it's subdued to its potential, or it's still off the potential that it could be hitting, it's still very important for global multinational companies who are both producing and selling and shipping to China. So, yes, it's diminished in the overall global growth story, but it's still very important on a sector basis and still very important in the bigger picture, especially when it comes to trade as well.
Yeah, AKA all the luxury goods companies need the Chinese consumer to start playing ball. And we had the PBOC today. They didn't trim their rate. Why not? Why not? If we have this data that is so weak and there are concerns that we have yet to reach the bottom, why not have a PBOC that acts?
Well, I guess two things on it. The first point is, does China really need lower shorter-term interest rates? I mean, there's a view that money's already cheap enough in China and nobody wants to borrow, so you have to get the animal spirits revved up in the first place. That's a domestic China story. But, Danny, to your point, it's also the external story, and a lot of that comes back to Washington, D.C. There's a lot of pressure on the yuan, and there's a view that China doesn't want to cut rates in case it weakens yuan further and puts pressure on, those wanting to get money out of the economy. There's a view that they're waiting for the Fed to move first. And as you all know better than I, the Fed story, they're still on pause. They may or may not move over the coming months ahead. But it's an example of how the PBOC is locked into the dollar and the Fed story. They're reluctant to move now for fear of weakening the yuan further. They want to hold off and see what the Fed is doing and look for that window to bring down rates at the time when they can.
And this morning we saw China launch their anti-dumping probe about pork imports going into China. Do you think this is a fresh, new iteration of a trade war between the European Union and China?
I think, so there's the economics of it and the politics of it, Anne-Marie. The economics of it, probably less significant. I mean, yes, China is Europe's biggest export market for pork, but it's a fraction of overall trade. I think it's worth less than $2 billion overall. And that, by the way, those volumes have been in decline. And on the China side of things, it won't necessarily do much for China's pork import market either. It won't necessarily stoke inflation per se, given it's a small part of the overall bucket. So the economics less significant. But yeah, to your point, I think politically it is significant. It's an example of China saying, look, we're not going to take these measures lying down. We have some tools ourselves. We can respond as we want to. Obviously, this is in response to, or it looks as though it's in response to the EU probe into industrial subsidies and the tariffs on EVs. The trick for China, though, is they've been trying to court Europe. Remember that visit by President Xi to France only a month or so ago? They don't want to be seen as necessarily overly harsh on Europe. They want to maintain those business links. They're trying to court both Berlin and Paris. They can be seen as going harsher on the US, but they don't want to lose the allegiance that they have in building there, and especially with the business community in Europe. So I think that's the tricky part for China in all of this. They want to be seen to respond, but they don't want to be necessarily isolating themselves from Europe either, because they need Europe given the tensions that are ongoing between China and the US right now.
Our own Enda Curran, thank you so much for taking the time and giving us some insight here. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. The season's first heat wave stretching from the Great Lakes to the Atlantic Ocean is set to raise electricity demand and slow transportation networks. Manhattan is set to reach 91 Fahrenheit on Tuesday and steadily get hotter through the week, with humidity making it feel closer to 100 degrees, according to the National Weather Service. And as you were discussing, China has launched an anti-dumping probe on pork imports from the EU. It's the latest in escalating trade tensions between Beijing and Brussels. China is the EU's biggest overseas market for pork, although exports have fallen off in recent years due to domestic oversupply and low prices. The probe is seen as Beijing's counter to similar investigations being conducted by the EU, which is looking at Chinese subsidies across a range of industries and will impose tariffs on electric cars coming from China starting in July. And Bryson DeChambeau taking home a second U.S. Open trophy over the weekend, holding off Rory McIlroy by one stroke. In a wild final hour of golf that saw brilliance and some blunders, McIlroy bogeyed 3 of his final 4 holes, while DeChambeau sealed his win, hitting an incredible 55-yard bunker shot on the last hole and making his 4-foot par putt to take the title. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, investors bracing for loud week of Fed speak this week.
What my view would be is I'd like to see a few more months of inflation reports that are positive in the sense of similar to what we got last month. I'd like to see that continue.
That's coming up next. This is Bloomberg. Coming into a new week without a lot of action in markets, coming off a week of record highs. Although interesting last week, the S&P was up 1.6%. The NASDAQ composite was up double that, 3.2%. And that really speaks to the divergence that we continue to see this morning in equities. Under surveillance this morning, investors bracing for a very loud week of Fed speak.
What my view would be is I'd like to see a few more months of inflation reports that are positive in the sense of similar to what we got last month. I'd like to see that continue.
So we're in a strong position, but if you just said there's going to be one cut, which is what the median indicated, that would likely be toward the end of the year.
Here's the latest. The Fed's Williams, Harker, and Cook all set to speak just today. Tomorrow we'll get retail sales. And Thursday, another round of jobless claims. In the meantime, a number of other Fed speakers will deliver some utterances. Kelsey, Berro of JPMorgan writing this. The belief remains that inflation and labor market data will support rate cuts later this year, enhancing fixed income flows and credit opportunities, with corporate fundamentals remaining robust and supporting tight credit spreads. Kelsey joins us now, and this, to me, has been one of the ultimate tensions. At what point do we see rate cuts with this soft landing possibility that we heard from Stuart Kaiser is getting narrower and narrower at a time where the data does seem to be weakening a bit more around the edges?
Well, I think in general, looking at this all very holistically, it's really going the way that the Fed would like it. Inflation has been improving over the last two reports, and I think that that is exactly what they wanted to see. They wanted to feel comfortable that Q1 was the aberration, not the start of a new trend. We've seen that. And then on the labor market side, you know, this was really our debate. We had our investment quarterly last week in Columbus, and the debate was, you know, what do we take from all these labor market signals? You have the magnificent strength of payrolls, and then, as I would call it, the sneaky weakness in the household unemployment data. I think the reality is probably somewhere in between. And it's actually exactly what the Fed wants. Again, we're circling back to this idea that inflation is cooling, the labor market's rebalancing. It's going to be enough for them to be able to reduce policy restriction a little bit. But, you know, nothing's falling off a cliff.
And this is something that you talked about, how the biggest debate at that quarterly meeting was this issue of the labor market weakening and whether it was sort of the beginning of something more protracted. What I noticed last week is we did see this divergence between large caps and small caps. In credit markets, you saw spreads widen materially in high-yield bonds in particular, which was interesting given the rally into duration. Putting aside the increased in creditworthiness of some of these companies and some of the refinancing that we've already seen done, does it concern you that at this point maybe all the good is up when it comes to spreads, and that if you want to bet on credit, it's a duration play at this point?
So spreads are tight, and so I think there is a limit to how much tighter they can get. It's going to have to come from some of the lower quality names, which are what is keeping some of the yield in the index right now. But I would say, you know, the thing that I found notable was that the correlation between duration and risk is turned right way, and that's because inflation has been coming down as we anticipated. So how we build portfolios right now, how is it different from 3 months ago? Well, 3 months ago, we were leaning into credit. We still really liked investment grade and high yield, thought the corporate fundamentals were strong. I think the difference now is trying to find those hedges in portfolios, because now we're 3 months closer to the election. That's a risk. We've also seen some mixed data on the labor market side. So where can you find hedges that allow you to keep invested, keep collecting that carry? Because ultimately, in a negative yield curve environment, we do need to figure out how to build yield into portfolio, but also look at those hedges. I think the hedge that looks most attractive to us right now would be yield curve steepeners. So 2 areas where I think that works. One is if the labor market weakens unexpectedly and that household survey and that 0.6 increase in unemployment is the start of something more material, the curve is going to steepen because the Fed's going to be cutting more aggressively. On the other hand, I think the risk is election. That's a term premium story, and again, potentially good for steepeners.
So is this a steepener then, to your point, if it is concern about what the economy is doing? Is that a front-end story then? Where on the curve is that normalization happening?
So I think the normalization does need to come from the front end ultimately, and that's where you're going to get the disinversion. But one of my kind of long-standing beliefs has been that the yield curve will be inverted for longer than anyone expects. So it's been about 21 months, maybe 2 years now, where the yield curve has been inverted. That's the longest stretch on record without a recession. And to me, I think that yield curve inversion can probably persist until the Fed is really cutting in earnest.
As the November election comes more into view, when you say risk, what do you mean? What is the biggest risk?
Well, it's difficult to handicap right now, and I think that's why we call it a risk. I think there's the stimulus part of it, so the concern that there will be less focus on managing the deficit. But I also think that the tariff side and how we're going to approach foreign policy is also a really important risk. So I look back at when Trump was last president, and I look at what happened the last time we had this tariff war. And a lot of people talk about the inflation impact, but if you look back, it really wasn't inflation that was damaged by the tariffs. It was global manufacturing sentiment, and it was the growth impulse. So I think we need to also be aware it's not just a one-sided story. I don't think it's all about, the risk of higher inflation. I think that there's also a risk on the growth side.
But when it comes to that fiscal impulse, do you see that changing? Or is there any daylight between Biden or Trump for a fiscal policy impulse?
So I think this is where it gets tricky. And when we were building out our scenarios for our quarterly last week, I mean, you can't just have a Trump and Biden. You also have to play out the House and Senate scenarios, because I think that's really, really key. Right now, you have to, within your deficit forecast, consider the tariffs. Also consider the tax cuts. Will they be sunsetted? I don't think anyone thinks that's going to happen, but will they be extended, or will they be doubled down in a sense that it will be actually stimulatory? Because the deficit is already quite big. So there's a hurdle there for an additional fiscal impulse above and beyond the deficits that we're already running.
So before we get to November, we have to get through this week, and we've got retail sales tomorrow. We've got jobless claims on Thursday, and then on Friday we get the latest manufacturing data and services from S&P Global. What's going to be most important to understand whether we're still on track for that soft landing that keeps you in a sweet spot in credit that has seen an improvement, at least on the margins in creditworthiness?
All right, so I'm going to say something which is none of the things that you listed, which is actually claims. So I remember the last time that we were on, we were talking about the fact that the soft data has been telling us that the economy is terrible. And in reality, the hard data is what's holding up, and that's what's ultimately most important for the Fed, i.e. payrolls, i.e. CPI, PCE, and claims. So again, we saw that small tick up in claims. I don't think that 1 week really means much anymore. That's just kind of noise, but we do want to watch it every single week. And that can reflect a turning point. Maybe not this week, but that's what you want to watch.
Pause.
The hard data.
Okay, so how many weeks do you need before it's a trend? And what kind of increase would you need to see before suddenly you start to say, wait a second, this is something more concerning?
So this is getting a little bit in the weeds, but the way that I look at it is I actually look at the non-seasonally adjusted data, and then I look at the path relative to prior years, because there's a trend, and it's been very difficult to seasonally adjust the data in this post-COVID world. And so what I need to see is that the claims numbers are running off course relative to the path, the seasonal path for claims. So it would need to be, let's just say, more than 1 week, a number of weeks, where it is clear that we're running off the path of the seasonals.
And just real quick, the playbook, if you see that, go into long duration, move out of riskier credit.
So I think the Fed has been really clear here, which is that they will shift if the labor market data weakens. You know, that's a question that he's been asked at the press conferences, and he's been very clear that their framework is hold or cut. And then what brings forward rate cuts to be more urgent? It's downside risk to the labor market. We haven't seen that. If we see it in the hard data, not the soft data, that's what's going to get the Fed to move.
Kelsey Berro of JPMorgan, thank you so much. Always a pleasure having you here. And it raises this interesting question, Danny, which is the Fed put. Is that essentially what people are betting on, that it will come back into play with just the whiff of weaker employment data?
Yeah, because it's the irony of asking if that happens, if the labor market weakens, do you need to get out of risk? And maybe the correct answer is no, you don't, because to the point that we were just talking about, it means that the Fed is more likely to take action, and the Fed put comes back, and you can keep buying riskier credit, and spreads can continue to grind tighter.
And unlike inflation, where it feels like they need to see several reports, to Kelsey's point, it feels like with the jobs market, if they see one bad report, potentially we can see a big shift at the Fed.
And it just depends on what that looks like, right? Especially given the fact that we said we were talking about how Jay Powell noted that the payrolls report overstated the labor market. Coming up, we're going to be speaking with Lindsay Rosner of Goldman Sachs, Sam Stovall of CFRA, Stephen Major of HSBC, and Lydia Boussour of EY. Right now, you're seeing markets treading water after a week of record gain after record gain. This is Bloomberg.
We've got a broad story where the economic fundamentals look good, right? The growth story is pretty good. Inflation is coming down.
As far as what the Fed signaled, I think it was a very balanced sort of a message.
We're seeing slowing in growth, but we're not really seeing such severe slowing that monetary policymakers seem like they really need to act urgently.
I don't think there's a lot of concerns necessarily about the U.S. economy going into recession.
The Fed's telling you they're going to cut rates even if the labor market stays tight. So if it weakens, they're just going to cut a lot more. There is a support network that's happening there.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Heading into a key week of economic data, kicking off tomorrow with retail sales. Today, we are left trying to understand the narrowness of the rally that we saw over the past few months and how it is getting narrower and narrower. Good morning. I'm here today, so pleased to say Anne-Marie back in her seat after her tour in southern Italy. She was really excited to be back. Danny Berger here. Thank you so much for being with us. John Ferro not here. He is on his tour of duty somewhere warm and beautiful with great food. Right now, we are looking at a market that is basically trying to find direction after a week. I have to say, I really can't emphasize enough how narrow the range is and how dominated this entire rally has been, Danny. Just from an incredible rip-roaring belief in AI with a couple companies and nothing else.
It's interesting how the shades of this rally have changed, because at first we said AI, but AI plus everything. AI would be in utilities. AI would be in consumer stocks. So everything can rally off the glory. It's changed. It's changed back to maybe it just is NVIDIA is the winner. Maybe Broadcom gets a little slice of the pie, but the flavor has changed and makes it all the more vulnerable.
Which raises a question, vulnerable to what, right? Is it politics? Does it really matter what Fed policy is to NVIDIA? NVIDIA doesn't need to borrow money. If anything, they've got a cash pile that's invested in T-bills that will only do better if the Fed remains on hold. So this raises the question, what risks? Last week, let's remind everybody again, Anne-Marie, you were in southern Italy, really enjoying yourself, and I'm sure you were very happy to come back. You did break a lot of news, and it was during a really pivotal period of political developments and political risk really coming to the fore. How much do you really hear about this as something that people thought of as just the beginning of a number of political surprises?
It was a parochial G7 in the sense that domestic politics loomed large over basically everyone there but Giorgia Meloni, the host. And it really was her show. It was her G7. Obviously, the concerns about France, they're starting to quell in the market because Marine Le Pen is coming out and she's talking about that I'm not here to ruin institutions. We can cohabitate with Macron. But then you look at potentially if this, once the risk is over in Europe, we get a little bit more direction on where they're going to be, whether it's France or the United Kingdom, then it becomes the United States. And I'm looking back at the data we got on Friday from the consumer sentiment, and it feels like for the first time we're seeing that hollowing out of the middle class. This economic story that Biden potentially needs to come out and try to sell the data to the American people, because when it comes to consumer prices, they're not feeling it.
Well, and you pointed out to this aspect of the University of Michigan Consumer Sentiment Survey that I thought was probably the most interesting aspect, and I'm glad you brought it up, the fact that the middle-income consumers are feeling the same as the lower-income consumers, and how unusual this is, because usually the middle feels the middle, and you've got the high end and the low end. Danny, how much does that speak to retail sales coming out tomorrow, and this question of how can they hold up in that?
Exactly. At some point, surely your feelings reflect how much you spend, but Jim Bianco says that it is back to politics, that the change we're seeing are middle-class Democrats who believe that Trump will be the next president. So their perception of the economy and how their future standings are going to shake out. That's what we're seeing in the Mitch survey. But Anne-Marie, that doesn't exactly point to great news for Biden either. Either people are unhappy or they've already just said, Trump's going to win. If you translate this into market activity, it doesn't matter, because if you've got chips, you're happy, and that's basically what's been driving the market up. Today, we can see a similar type of trend, albeit in a muted fashion, with the S&P basically doing nothing, but just a touch lower, while you still have the NASDAQ inflected upward ahead of the open. Euro gaining just a bit versus the dollar after a very difficult week last week in the face of some of the news we were just talking about, with the shift to some far-right types of candidates, particularly in France in a snap election, 107.10 there. You could see yields up a little bit more now, up about 3 basis points. You've got 4.25% on the 10-year, and crude kind of bouncing around. It was lower, now up about 0.3%, $78.71 on the NYMEX. Watch this space, especially ahead of a very hot snap in terms of electricity usage. Coming up this hour, we've got Lindsay Rosner of Goldman Sachs on a path for a September Fed rate cut, Sam Stovall on CFRA on text dominance and equities, and Stephen Major of HSBC on the global macro outlook and why he sees a rip-roaring rally ahead for U.S. Treasuries. We begin with our top story. A busy week of Fed speak kicks off as investors look for clues beyond the Fed's dot plot. Lindsay Rosner of Goldman Sachs writing this, quote, paths to a September cut do exist, and there were some signs from Wednesday that more cuts may be possible. Powell said confidence 20 times, and confidence, after all, is just a feeling. Lindsay joins us now to talk about feelings, but I am curious about, what we learned from the Fed last week and whether it matters for a risk asset rally that seems to be completely independent from anything related to the Fed.
Yeah, well, it does matter. And we learned a lot last week, back to the point that confidence is a feeling. We've heard for a couple months now that the Fed needs to feel confidence that inflation is moving in the right direction. Also, if they become unconfident in the labor market, i.e. see softness, they could go ahead and cut. What we learned last week is that if you tear apart the headline, which is the median dot went from 3 to 1, unpack that a bit. The mode, so where most of the people are hanging out on the Fed in terms of dots, that was 3, it moved to 2. That made the math shift down on the average to 1. Basically, there are a lot of ways that we could get to 2 cuts this year. And that would be probably September and December in our mind, because there really should be an air pocket around November election.
So you talk about all the importance of listening to the Fed speak. We got plenty of it this week. I mean, really, it's pretty much every day you get at least 1 to 3 Fed speakers. What do you want to hear? Who do you think is most important aside from just simply Fed Chair Jay Powell himself?
Powell is probably the most important, but it's not, as we know, his sole decision. It's going to be important to hear the different speakers out there, but more importantly than what they say is what continues to happen with the data. Remember, we had 3 really hot inflation prints, then we had a lukewarm, and this past one was cool. It was actually really cold in many ways, despite the summer heat wave we're about to embark upon. So we need to see the data continue to go in that direction. And the big thing that didn't move in the CPI that I think is important and people have been waiting for is OER. Very sticky, big part of CPI. But that moves with a lag, and it usually is a year or so of a lag from when rents start to move. So that could be happening any print now. We've got 3 prints before September. There is a case, in fact, that the Fed does go in September. But big picture, we're talking about maybe 25 or we're talking about 50. I think what you're highlighting on risk assets is really crucial. Risk assets have just cruised through this whole thing, and they ignore the volatility. That seems to us to be a bit strange. So when we look at where valuations are, we're finding spreads like everybody else, as the guest prior to me had said, valuations are on the really tight end of the range. Everything needs to go perfectly for that to continue to make sense. And last week, we had a ton of news. We probably didn't need more. The U.S. was enough. But sure enough, we got the snap election told to us that's happening in France. And we've seen a ton of volatility there in rates. So I think that needs to be a heads up to everybody in the U.S. You are buying assets right now at the tightest spreads they've been in a decade. There is likely to be volatility around our own election as well. It would be naive to think we don't see some of that here. So we're really looking for pockets of value if they emerge through the volatility. But we don't believe France, for example, is a contagion. But just the issue of that should be contagious. Think about it in the future. Unlikely we stay at the same place.
Right, remarkable to watch a VIX dip below 12 last week amid everything that's happening. But the strength in the valuations you're talking about have been, again, those big AI plays. It's been the NVIDIA. The rest of the market, the equal weight fell last week. It was a record divergence. Why would that be the case if we're going to get a cut in September? Why would that be the case if things are slowing, not slow? Shouldn't the rest of the market be playing along?
Well, the rest of the market is trying to figure out, is this robust growth that I think we keep coming up with explanations for? Well, is it, to your point, is it AI everything? Is it actually the labor market is more productive? Oh, wait, we have this immigration number that is enhanced, not in documented, but some undocumented. Constantly looking for ways to justify what's going on with stocks. The big picture is there is a look through to everything. Bad news, just put it on the side, keep buying. And we're trying to say, take a moment. This thing that's happening in France is important for remembering. Valuations are really important. Your entry point does count. And we feel like there could be some opportunity to have a better entry point in fixed income, despite the fact that yields are high. And the big also takeaway for us last week is you don't want to be underweight bonds. Look what did really well on the back of volatility last week.
When you look at France, you keep saying take a look at that. Look at not potentially contagion, but the volatility it sparked. But do you think it's overdone? When you look at the polling, it looks like potentially we're just going to get a hung parliament.
No, I don't think it's overdone. France, in our mind, was really trading very tight if you look at it in comparison to Germany. And that we're now at a level, a spread between the two, that makes a lot more sense. Very different economic outcomes or forecasts that we have there. So we've gotten to something that makes more sense. And it's not an egregious move. It's not a massive, massive move. But again, back to the tight spreads and the price for perfection we see across the globe. Really important to remember something like this, a little ripple in the water can actually really start to move things. And there's an asymmetry when you're buying at the tightest levels.
Looking for a better entry point is code for we expect a sell-off, right? I mean, this is basically another way of saying we're looking for declines in valuations because this just looks a little bit too perfect for us. Mm-hmm. What in particular do you think is so vulnerable right now?
Yeah, so we've been talking a lot about the impact of higher for longer. I don't think we're alone in sharing that. When you've had this higher cost of capital, you're going to see certain capital structures that don't work. And if we begin to see volatility ripple through the market, it is those capital structures that will be in the most pain. That will probably lead to some opportunity elsewhere. So for us, it's not see something that's distressed, see the crisis, want to invest there necessarily. It's if things start to trade in sympathy, and i.e. widen, that's where we want to step in for things that we believe in from a fundamental perspective.
You also said you don't want to be underweight bonds, and this is duration, right?
Yes.
This, to me, is an interesting point. You don't see the risk, despite some of the politics of the moment, you don't see the risk in benchmark U.S. rates at a time where political risk is not just a European effect.
Totally true. And we think bonds are going to do what bonds are supposed to do. And there's been a question, I think, for the past few years, what is really the role of bonds in a portfolio? Do you actually need them? Stocks just take off. Forget about it. I'd rather just be in equities. And I want to be able to talk about it at a cocktail hour because people want to talk about NVIDIA. They don't want to talk about the 2-year. But
depends what parties.
Yeah, okay, maybe ours, maybe this cocktail party that we're having here, and it's a good one at an early morning in the hour. But you want to have bonds in your portfolio because they protect you. And I think when you look at what happened in France, look how much Germany rallied. So get a ballast in your portfolio of the safe haven quality assets. They will benefit you. And then if you see some inefficiencies begin to erupt in the spread markets, we want to step in there and add.
Lindsay Rosner of Goldman Sachs, thank you so much for being here. Great to see you. It's been too long. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. European markets are edging higher despite continuing political volatility in France. Citigroup strategists downgraded the region from overweight to neutral, citing the risks from a potential far-right majority in France in the upcoming parliamentary elections. But French far-right leader Marine Le Pen bringing calm to markets, telling a French newspaper she'll work with current President Emmanuel Macron if her party wins the elections, and that she is not calling for institutional chaos. Bill Gates saying he's ready to throw billions of dollars into a next-generation nuclear power plant project in Wyoming to meet growing U.S. electricity needs. The billionaire told CBS's Face the Nation that his energy company, TerraPower, relies on sodium cooling rather than water, which is believed to both simplify the process while also being safer and could make nuclear energy a source of low-cost electricity. Gates saying TerraPower's plant is on track to start producing power by 2030. And Pixar's Inside Out 2 is Hollywood's best debut since Barbie. The movie grossed $155 million at the box office in the U.S. and Canada, besting Dune Part 2 as the movie with the biggest opening weekend of the year. The film also notching a record. Inside Out 2's nearly $300 million haul globally is the biggest opening weekend in history for an animated film. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. We still have to get Emery to a movie theater because she has not yet been since the pandemic. Up next, the morning calls and Sam Stovall of CFRA. That is coming up. This is Bloomberg. Into a week dominated by retail sales, jobless claims, as well as what we get from S&P Global on Friday, which is manufacturing and services activity data. Right now, not a lot going on. The S&P has crossed that 5,500 mark, basically unchanged. What you can see on the NASDAQ is actually, again, an outperformance, even as small caps underperform. Right now, let's take a look at morning calls. First up, Goldman Sachs upgrading Toll Brothers to neutral with a price target of $124. The analyst expecting higher revenue and outperformance in new home sales. Next up, Bank of America raising its price target for Micron to $170 from $144. The firm expecting the chipmaker to benefit from increased requirements to support artificial intelligence in personal computers and smartphones. And finally, UBS upgrading Best Buy to buy with a new price target of $106. The analyst expecting an electronics replacement cycle helped by, you got it, innovations in artificial intelligence. Sam Stovall of CFRA also looking closer at the tech trade, saying this: even though 6 sectors also advanced, the tech sector was the exclusive outperformer last week, causing one to wonder just how long can this jumbo jet keep flying on only one engine. Sam joins us now, and Sam, I have to say, this in some ways is the quote of the morning to me, given the fact that this is the ultimate existential question. Is this U.S. stock market ultimately incredibly vulnerable because of the dominance of the big tech names, or is it incredibly resilient because of them? Is it a feature or is it a bug? What do you think?
Well, Lisa, good morning. I think that it is resilient. However, I do believe that we are headed for a second decline of 5% or more in this year. Good news is, however, that based on my historical work, every one of those top 15 first quarters ended up with a gain for the entire year, even though many of them went through 2 intra-year declines of 5% or more, and those average annual increases exceeded 20%. But when I look to the S&P 500, I see it trading at a 32% premium to its average 20-year PE. I look at tech at a 68% premium, and I look at tech at a 21% premium on a relative PE basis. I do sort of wonder if we've gone too far too fast and need to reset the dials in order to maintain this longer-term upward trajectory.
So basically, you're saying that you think that tech is going to pull back a bit as the rest of the index maybe just hovers around where it is now, and that's what's going to drive the index level 5% lower. Is that what I'm hearing from you?
Well, I'm saying it's going to decline by at least 5%. Actually, history would say that we're probably going to experience a mild correction. So that 4,800 level on the S&P, I don't think is out of the question at this point. I think that if we do start to see people take some profits in tech, it's not going to be just tech alone. Tech and consumer communication services are the only two sectors that are outperforming the S&P. Since we had about 68% of the S&P 1500 sub-industries trading above both their 50 and 200-day moving averages. Today, that number is down to 38%. So while the market has been advancing, it's really being led by tech and, to a much lesser extent, communication services.
Sam, it's been a long time since we've seen a 5% more or decline in this U.S. stock market. It's been a long time since we've seen a 2% decline in this stock market. It is, as Bank of America once called it, the Pavlovian urge to continue to buy because stocks keep going up. What needs to change? Because valuations alone haven't spooked investors. So what changes that allows for that sell-off to happen?
Sure. Well, we did experience a 5.5% decline from March 28th through April 19th, and we recovered everything we lost by mid-May, which is not surprising because of the 64 declines of 5 to 10% since World War II. It took us only a month and a half to get back to break even. So that's why I typically say that you're better off not allowing your emotions to drive your portfolio decisions. But as we saw last time with the 10-year yield creeping higher, causing investors to worry about where it would end up peaking. Also, the worry about the Fed not likely to cut interest rates 3 times, as the March dot plots had indicated. Most recently, expectations were for 2, yet I found that investor ebullience was dashed by the dots this time around, with the expectation now only being at 1. So I think the question is, how long will the Fed maintain higher for longer, and does that increase the risk of recession?
You talk about in your note this frustration by the Fed, and people could have been humming the Meatloaf song, 2 out of 3 ain't bad. What are you expecting this week then from all the Fed speak? Do you expect them to be a bit more dovish, given the fact that the data potentially may mean they're going to cut before December?
Well, Neil Kashkari's comments, I think, were basically what he's been saying for a while, which is much more of a hawkish tone. Other commentary could, yes, take the other side as well, because the Fed wants to remind us that they are data dependent. At the same time, I think they want to let us know that they are independent of political pressures. Every election year since 1992, except 2012, had the Fed either raise or lower interest rates in that election year, and many times it occurred in September. So I don't think the Fed would be averse to cutting rates if they felt that the data supported it.
And you still think September remains in play. What's your biggest conviction for that?
Well, when I look to the CME forecast model, I see that we're looking at 1/3, or a 38% in a sense, indicating that we're probably going to stay at that current level. But obviously, 62% are implying that we will probably see a cut in September of either 25 or 50 basis points. That moves up to 80% for the July period, and even higher for December. So I would tend to say that the chances are increasing that we do end up seeing a cut sometime this year, with possibly 2 still on the table.
Sam, a lot of people would agree with you. Last week, we saw a massive rally in U.S. government debt. I'm looking at a 21 basis point decline in 10-year yields, down to 4.22% to end the week. Why is that not igniting a rally in some aspects of the risk market that have not participated? I'm thinking of small caps in particular.
Well, I think first off, the reason that one reason why the yields have been coming down is because the prices have been going up because interest rates look more attractive here in the U.S. than in overseas. So that's attracting foreign investors. We certainly are looking at small caps now trading at a 31% discount on a relative PE basis, mid caps at 25% discount. I think it's because investors want to wait until the Fed does actually cut rates because of the potential of a rising risk of recession, since these smaller and mid cap firms are the ones that will take it on the chin more so than large caps should we end up having something deeper than simply a soft landing. So I think investors are playing it close to the vest at this point and focusing almost exclusively on the larger cap growth universe.
Sam Stovall of CFRA, thank you so much. And it does seem as though, Danny, the uncertainty on the macro front has just left people saying the only certainty that I have is that people are going to keep buying NVIDIA.
And that is exactly what I do think it's such a good question, though. OK, it is what we're seeing, but we're OK to say, all right, the animal spirits are going to be woken up so I can buy NVIDIA. Why not the rest of this market? Why can't we say there are going to be cuts and we can buy small caps? We're willing to suspend belief for the large caps. It does seem odd to me that this is the one place that we're saying we need to wait.
Especially at a time where people say, ostensibly, if you do get this adoption, it should benefit productivity across the board, to your point, but maybe not yet. Coming up next, a busy week of Fed speak, as well as some key economic data. We're looking ahead to it all with Stephen Major of HSBC and Lydia Boussour of EY. Tomorrow, retail sales. We haven't talked enough about that. We're going to be talking about that more coming up, just in terms of understanding how much ammunition some of these consumers still have. This is Bloomberg. Heading into a week of economic data led off tomorrow by retail sales. Those are the big hitters, although we are getting some coming out just momentarily, heading into that S&P futures, just hovering around that 5,500 level, not doing much. NASDAQ futures, though, with some modest gains, up about 0.1%. The Russell underperforming yet again, as has been the theme, with a record divergence, as Danny mentioned, down about 0.3%. What we're seeing right now, though, is a U.S. economy that has been generally trending lower, but not weak. And we get that again with Empire Manufacturing, which we will get to in just a moment. Right now in the bond market, you can see yields just a little bit higher, grinding a bit higher as the session grows on. At session highs, 10-year yields 4.26%, 2-year yields 4.73%, and 30-year yields at 4.40. Danny, it raises a question at what point people still look at bonds as a haven trade, because what we saw last week very much the place where people go for safety. And Lindsay Rosner of Goldman Sachs saying just moments ago, that's the trade that she likes.
Yeah, maybe it takes chaos, messiness, whatever you want to label it abroad, for us finally to like U.S. bonds again. There's one argument I heard that I thought was interesting, that French banks selling off last week meant that they pulled back from the U.S. repo market. So actually what we saw last week was just a dearth of liquidity. And that's why bonds moved as much as they did, because French banks that usually play a lot in this market because of political chaos there weren't. So it's just another roundabout way to saying French politics affecting U.S. bond market.
Which is something we'll be looking at. It's certainly affecting the currency space. What we see right now is a euro trying to retrench just a little bit after last week's real damage done to its valuation in terms of weakening versus the dollar. Today, some firming up 107.12, but very much front and focus. Under surveillance this morning, Goldman Sachs and Evercore boosting their year-end outlooks for U.S. stocks. David Kostin and the team at Goldman Sachs looking for 5,400 from 5,200 on the S&P 500. Here's the big call. Julian Emanuel and the team at Evercore making the leap to 6,000 from 4,750. And Anne-Marie, we see this pretty much across the board with people saying just because it's a thin rally dependent on a few names doesn't mean it's going to stop.
Doesn't matter. They think it's going to continue. What I found so interesting about the Goldman Sachs call was actually they gamed out a few other scenarios. And they said if exceptionalism persists, they're going to be closer at Evercall core of 6,300 by year end. So it just looks like they have a number of scenarios where, for Goldman Sachs, that initial call is just the base case for how much higher we could see before year end.
I'm kind of surprised we aren't hearing more of the David Einhorn kind of argument that something is broken, that something else is happening, that only these big companies keep getting bigger because there are too many price insensitive buyers, that it's all of the machines, it's all the S&P 500 retail buyers, that it's all of the hedge funds who are just buying tech and that's it. And that something is fundamentally different this time. That means the fundamentally okay companies, the value stocks, this time won't catch up because that buying base doesn't exist for them anymore.
Well, and it also doesn't have the same kind of buyer base of the actual businesses themselves in the same way that Google and Microsoft are the main buyers of NVIDIA chips. So it becomes sort of circular. The big keep getting bigger because they're helping each other on an ecosystem amid a technological shift. Talking about technological shifts, that's going to be on the docket as the campaigning season heats up. The Biden campaign raising more than $30 million after a star-studded fundraiser in Los Angeles over the weekend. President Biden also kicking off a $50 million ad campaign ahead of the debate with Donald Trump on June 27th. According to Axios, Trump is scheduled to meet with Speaker Johnson at Mar-a-Lago later today. Anne-Marie, fresh off your tour of Europe, heading into this debate, what are you watching in terms of tactics, in terms of trying to get some of the double haters back on stage?
That's true. The double haters, 1 in 4 voters say they don't like either candidate. This is a big problem for them, and they're trying to win them over. What you just said there, this $50 million ad blitz from the Biden camp, they're calling it character matters. This is what they're trying to tap into when it comes to the electorate. And what Terry Haines, I think, put it really well earlier in the program. Trump and Biden, when they get on that debate stage, they both want to basically define the terms of this election and try to get one of those 4 to come over to their side.
Which has been the big challenge right now. And then the question is what the potential political risk is, given that we just saw it did matter over in France. I mean, how much are people actually gaming this out? A lot. How much are they actually trading on it? Danny, do you have a sense? I mean, my sense is not that much yet.
The only place I've seen it is the VIX. And I mean, this is slight. There is a slight kink around where the election is. But perhaps the only reason that's the case is because we know who the candidates are going to be, so we've priced it in a little bit earlier. Otherwise, we don't see it. And again, it's not just France. We learned this lesson with Mexico. We learned this lesson with India. And again over the past few months, we are not prepared for elections.
We are prepared for Fed speak, and we get a lot of it. This week, comments coming from Williams, Harker, and Cook later today. There are 6 more speakers tomorrow, plus retail sales data. On Thursday, more Fed speak, plus jobless claims. Michael McKee, Bloomberg economics and policy correspondent, joining us now. It was the quiet period. Now is the very loud period for the Federal Reserve. What are you watching to really indicate where the bulk of the FOMC is at a time of incredible divergence, really?
I don't know that we get a complete view of that because they're going to be data dependent until the next meeting, which is until July 31st. We just got Empire Manufacturing today. It's down to -6, but it was -15.6, so an improvement to still contraction. And new orders were better, so maybe we get this mixed message from all of these data points that we're getting, and it's hard to know what the Fed's going to do. But as you say, we have a lot of economic indicators. It's retail sales that matters this week because it'll give the Fed some idea of where consumers are and whether the economy is weakening, because certainly the Atlanta Fed GDP now doesn't show any signs of weakening. But we're going to go through this on a regular basis, for the next month and a half while we wait for the next Fed meeting.
Is there any expectations that retail sales might show some of the weakening, might show some of the survey data, so that some of that finally might filter through?
Well, that's an interesting question. Bloomberg Economics thinks so, but most other economists don't think so. We had a decline in the core retail sales last month, and now the consensus forecast is it goes up by 0.4, and the headline goes up as well. So this is even with gasoline prices going down, and because retail sales are denominated in dollars, that's a hill to climb, but economists think they're going to do it. And we've seen reports from the various credit card banks that consumer spending has been holding up.
But when you look at retail sales, even if we do get a weak retail sales print, that's not going to be enough to move the Fed, is it?
No. The Fed is going to be looking at the inflation indicators, and they're going to be looking at the employment indicators. We've already got bond market analysts complaining about the fact they have to work on July 5th because it's going to be the jobs report. But that'll be a very important jobs report because it'll set the tone for what happens on July 31st. And then that sets us up for whether or not you get a September move.
Michael McKee, thank you so much. We really appreciate it. Stay close. I'm sure we will be speaking plenty this week amid all of that data as well as Fed speak. Right now, we want to dive into what to expect for the remainder of the year and whether the balance of risks has shifted as we do see a disinflationary tilt to more of the data, at least, in the United States. Joining us now, Stephen Major of HSBC and Lydia Boussour of EY, both with us. Lydia, I want to start with you in terms of what you make over the rally that we've seen in bonds over the last couple of weeks in particular, and what this signals about where the balance of risks is at a time when the Fed kind of had a hawkish tilt last week.
Yeah, so we've seen a softening in economic data, and I think that the narrative has been shifting towards the economy slowing more than what was, anticipated earlier this year when inflation surprised on the upside. So what we're seeing in terms of the economy is a gradual slowdown in economic activity. The Fed, last week was, somewhat, slightly more hawkish than expected. Coming out of this meeting, there is really this sense that they have lost some conviction that inflation is moving back sustainably towards the 2% target. So now when we look at, the next couple of months and the coming data that we were discussing, it's all going to be about rebuilding that confidence, seeing less that softening in sequential inflation, but also seeing some softening in the labor market for the Fed to be confident enough to start cutting interest rates.
Stephen, what did you make of last week, considering that we saw a hawkish tilt to the Fed, and you just reconfirmed in your mid-year outlook a belief in a rip-roaring rally in U.S. government bonds that could potentially take the 10-year yield to 3.5%?
Yeah, I'm quite glad we kept the bullish conviction. The news flow coming through on the back of these elections that you were talking about in the prelude to this interview, I think that really matters, and I think it kind of overwhelms the impact of the CPI and payrolls releases and the Fed speak. So I think it was yourself or Danny that spoke about chaos, and you both mentioned France and Mexico. There's a lot of commonality here. These are spread markets that have a lot of overseas or non-resident buyers behind them, and they don't respond well to volatility shocks. In this case, you've had election results that have brought the fiscal challenges back into focus, and bonds don't like that. So if you get a flight to quality, people move from French bonds to German bonds, from Mexican bonds to US bonds, and globally, it's all knocking on. And I think you've got an unwind going on of all these carry trades. So at a time of tight credit spreads and a bit of a vol shock, it's no surprise that treasuries are doing quite well.
Stephen, though, what happens when all of that meets U.S. political instability? If we do see something in November that looks like uncertainty about the results, confusion about the results, confusion about the policy, where does that money go?
Yeah, I guess at the start of the year, everyone was focused on how many elections there were going to be this year. It's taken till the halfway point, Danny, for there to be a significant shock, because the Indian result wasn't a big shock in a way, and it is a very domestic market. The reason Mexico and France matter is because they're so international. So the US election is still a long way away. And I think everyone who's watching this show knows that there's a lot of debt, and they know what the policies are of the two presumed candidates. So it's not like there's a big unknown out there. It seems to me that part of the reason the data is cooling is because the fiscal impulse is starting to fade. And I think all of us should just recognize whoever's the president in 2025 is going to have double the debt stock of 8 years ago. So whoever's there is going to be somehow restricted in what can be done in terms of future fiscal loosening. I don't think the US, by the way, is in that bad shape fiscally. I'm talking here about relative to other countries and considering the asset base. The growth of GDP has really helped. But of course, if the economy is cooling and the debt keeps going up, then you have more challenges. But I don't think the US Treasury market should be so worried about the debt.
Lydia, what about from an economist's point of view, if we do have, it doesn't matter who's in, we know what the fiscal situation is, what the debt looks like, a fiscal impulse that fades, does it matter? Do we need to start worrying about the deficit?
Yeah, I mean, we all can agree that, the fiscal policy is on an unsustainable trajectory. When we look at interest payments on the debt, they've risen, to 3% of GDP, which is double the pre-pandemic rate. Now, I don't think, this is threatening the outlook in the short run, but it does pose economic challenges in the long run. It pushes interest rates higher, can generate inflation, can, weigh on growth. And then more importantly, it also means that there is, more limited fiscal space in the event of a downturn.
Stephen, when you say that the U.S. doesn't look so bad, is that because relative to what is going on in the rest of the world that the U.S. doesn't look so bad? Or is it because you actually think the U.S. is okay when it comes to its fiscal trajectory?
Yeah, a combination of both. I don't know whether this is an English or American saying, but we call it the least dirty shirt. So I sort of imagine looking through my wardrobe and trying to find the cleanest, brightest white shirt to wear. It's a bit like that, in that the US debt stock as a percentage of GDP, if you look at the total debt, that's public and private sector, since the 2008 financial crisis, it's gone up, but it hasn't gone up as much as some other countries. And it's also been helped in the US by the fact that the household has delevered. So on a relative basis, it looks not so bad. And on a historical basis, it's okay. And I think that part of the factor is the strength of the GDP and the tax take. Now, looking forward, the US has incredible taxing ability. But as we know, it's all a question of willingness.
And it's also a question of policy. We have a new report out today talking about the fact that if Trump's proposal to exempt tips, for example, from taxation, it would be $150 billion to $250 billion added to the federal budget deficit. Is it very difficult to think about 2025 until we know, Stephen, the outcome of November? Or are you just expecting there's going to be a lot more debt added to the U.S.?
I think that that's a big number you just put out there, but there's also going to be money coming in on the other side, because don't forget there's money from tariffs, for example. I mean, we just don't know what the outcome is going to be, and it all depends on whether we have a sweep or not, because I think the fiscal outlook will very much depend on whether either candidate wins with a sweep. So it's tricky, and I think in terms of probabilities. At the moment, you wouldn't go down a baseline or base case of there being fiscal irresponsibility. I think that it is a risk, it's a scenario, but it's not the baseline. And at the moment, I look at US Treasuries and I think that they're priced appropriately given where the policy rate is. If the policy rate starts coming down, yields are going to fall, and they're going to fall quite fast. That's what really matters. Bond yields don't go up because there's a lot of supply. And it seems that some people want to inject additional term premium into treasuries because of the supply. I think it's already there. You can already see it.
Lydia, do you agree?
Yeah, I mean, looking at, the elections and what the implications could be for the economy, there is a lot of uncertainty surrounding, the post-election landscape. When we look at the economic impact, we really focus on two key themes that will be very important. The first one is fiscal policy, but the Tax Cut and Jobs Act in particular, and the expiration of the Tax Cut and Jobs Act, that's going to be an important issue, and can represent a mini fiscal cliff. We've estimated it could shave 1 percentage point of GDP. There is also what's happening on the trade front with the potential for escalation in tariffs. We are already in an environment where inflation is still elevated. So seeing, more inflationary impulse and, potentially some hit to growth would not necessarily be a desirable environment we want to be in, especially as the Fed embark on that easing cycle.
We're talking with Stephen Major of HSBC and Lydia Boussour of EY, both of you at a time when you're talking about yields going lower in the face of disinflation, as well as the U.S. just being a haven for a lot of dollars. Lydia, at what point do lower yields boost the economy, boost the economic activity in the United States, and have a self-reinforcing cycle versus indicate some weakness that actually would be negative for the growth prospects?
Yeah, I mean, when we look at the economy today, we're looking at an economic slowdown underway. We've seen some rebalancing in the labor market, some softening in labor market indicators. We're looking at consumers being more cautious with their spending, investments also softening, and companies being more discerning with their spending and hiring because of this tighter credit condition environment, and because consumer demand has softened and consumers are more price sensitive. So in this economic environment, with signs of softening in the labor market, we're expecting to see that recalibration in monetary policy happening, towards, September. We're expecting the first rate cut in September, and rates starting to gradually move lower and move away from that restrictive policy stance. And, by, seeing that those rates moving lower, we should, ensure that the economy doesn't slow down materially. We're expecting to see growth falling below trend in the coming quarters, but we're not expecting to see a retrenchment in economic activity. And the fact that the Fed is going to embark on that easing cycle should allow for that cycle to continue and run through 2025.
Stephen, what's your view on this? Because some people would say that this economy has been a lot less sensitive to rate hikes. Why would they be so sensitive to rate cuts?
Yeah, that's a fair point. So you have to be careful with this one, because I think that people are expecting just very modest rate cuts. And in fact, that's all conditioned by what the Fed's just told us in their dot plot. So I find a bit of an echo chamber around the mainstream forecasts, because they're all basically one standard deviation from the Fed. It strikes me that it's probably true that the economy isn't that sensitive to the rate cuts. But when the rate cuts come, I think they're probably going to be more than the market's pricing in. And that's exactly the point, that cutting by 25 basis points here or there isn't going to do anything. So when the economy is really cooling, and if unemployment is going up at a faster rate than the Fed's forecast, I think that could be a kind of scenario to think about. Then rates will be cut quite hard and fast. Also, Lisa, it's not just about the US cyclical economic data. It's about the structural factors, the huge stock of debt. It's about what's happening in China and Europe, and ultimately, US rates just look out of line with everything else.
Stephen Major of HSBC, Lydia Boussour of EY, both of you, thank you so much on a week where we'll be talking a lot about the Fed and rates. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hakis. Yahaira.
Lisa, President Joe Biden will host NATO Secretary Jens Stoltenberg today in the Oval Office. The meeting comes after G7 leaders agreed to a plan to tap frozen Russian assets to help aid Ukraine. But over the weekend, Ukrainian President Volodymyr Zelensky failed to broaden global support at a summit in Switzerland, with BRICS countries Brazil, India, China, and South Africa all declining to sign a final document of support. The number of Americans who say they don't like either major party presidential candidate is at a historic high, according to the Pew Research Center. The amount of double haters, as they're called, make up 1/4 of the electorate. That's nearly twice as many as at this point back in 2020. Double haters were a key factor in Donald Trump's upset win in 2016, when they broke for the Republican candidate over Democrat Hillary Clinton. The biggest threat to Biden and Trump is that voters will stay home or vote for an independent candidate like Robert F. Kennedy Jr. And for the first time ever, a Deadpool movie will open in both China and the U.S. simultaneously. Disney announcing that Deadpool and Wolverine will be released on July 26th in mainland China with, quote, minimal cuts. Previous Deadpool films saw either no release or months-long delays as the R-rated movies face scrutiny and censorship from China's Film Bureau. That's your Bloomberg Brief. Lisa?
Thank you so much. Up next, settling you up for the day ahead. You're watching Bloomberg. Taking a look at where markets are as we are about 35 minutes away from the open, and you can see not doing all that much right now, counting you down to the opening bell. Here is the trading diary for the week ahead. Today, the Fed's Patrick Harker, John Williams, and Lisa Cook speaking. Tuesday, retail sales, plus a host of Fed speak. Wednesday, UK CPI. Thursday, another round of jobless claims. And Friday, S&P global PMI data. Remember when that actually had a really significant impact on the market. So people who say it's not the ISMs, the ISMs, it doesn't matter, think again, because it has in the past. So for final thoughts, I know you were really key on cohabitation, but there are some other things that you're looking ahead to other than French politics. Anne-Marie, what are you focused on?
Well, I'm looking at politics stateside as well. I mean, obviously, you leave the G7. It was clouded by domestic politics and this concern. Biden comes back. It is full-on campaign mode. He went directly to a campaign in L.A., and everyone's going to be focused on the debate. I think Terry Haines had a really good point. It's how they want to frame this election and who comes off better doing that. So I'm interested also to see what retail sales says tomorrow, because where is the consumer right now? Because after that report on Friday, when you see the middle class saying they're feeling more like the lower income class structure, that's a big problem for this campaign.
I agree. There's also this issue of if there is weakness, what can kind of happen in response to it in terms of the fiscal impulse, given the fact that there already is quite a bit of debt. What are you focused on, given the fact, Danny, that we've had a whole host of potential importance aspects this week?
I think it's how the Fed speakers react to the data that we got, because the reaction so far we've heard, again, from Kashkari, from Mester, it hasn't been that great. They don't sound like people who would have changed their dot plot had they had the data in hand. So we're going to get the data. We're going to get, as you say, the loud period. Do they change their tone? We're just hearing from Stephen Major, who said, actually, they're going to cut a lot more than this market thinks. And Lisa, that's what makes a difference. That's what makes a difference to the maturity wall, into companies, into the poor small caps who can't rally along.
We'll keep talking about that. Coming up tomorrow, we have Laura Rame of FS Investments, Tony DeSpirito of BlackRock, Ian Shepherdson of Pantheon, and Greg Deco of EY, all talking amid that key question. If the Fed cuts, will they cut a lot? And just how flat on their back are consumers that have been feeling kind of rotten? This was Bloomberg Surveillance.